We continue to believe that we're going to see a global economic recession.
If we can get a soft landing, fantastic, but a hard landing is very much still on the radar.
We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates.
Given this price into the market, it will take a lot to derail a hike.
Our inflation forecast is strong enough on the downside that they don't need to hike again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City this morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene. I'm Jonathan Ferro. Your equity market just a touch softer over the last couple of days. Make it day three. We're negative 0.1%. Going into payrolls a little bit later on this morning. The estimate at the moment, Tom, 230,000. That creeping just a little bit higher in the last 24 hours following that blowout jobs report yesterday from ADP.
Blowout ADP, I have no idea what to expect. You got people saying ADP was a fluke. Down we go. We're going to be disappointed. I got people saying there's some substance there. Up it goes. Basically it's head spinning Friday. I have no idea what to do. Thanks to No Context Bread. And we got Christian Horner coming up at F1 at John Silverstone. John, I don't know why we're not
going off the rails
why
already.
Are we not
here
at the paddock at Silverstone? You
know,
explain it to me. You're the British guy. But, I had, before we come out, we have a fully catered breakfast here. It's really, really wonderful. And I had the BAP. I just thought it was great. Explain to our audience what a BAP is. So when we have Christian Horner, we're like set up.
It's a bread roll. It's a bread roll, Tom. Silverstone's
like
in Northamptonshire. Yeah, you can put bacon in it.
Yeah.
So in East Midlands, I think they'd call that a cob.
We call it a number 2 value meal.
Do you? Is that what you call it?
That's what we call it.
I do wonder why we're doing this 1 minute into the program.
Because Christian Horner's a big deal.
Christian's
what
coming
a
up
year.
in 45 minutes. Looking forward to this conversation.
Looking forward to that.
Going
Jobs
into
day?
race weekend.
Jobs day, I'm sorry, I'm looking at 5%, 5.00% on the 2-year yield. Things changed yesterday. That's my lead this morning.
497,000 reasons why things changed yesterday. Just a massive upside surprise from ADP. Tom, I think people initially willing to shrug off ADP, and then you see the move in the market, and then they're like, oh, I guess we should take this seriously. Yields were surging. The ISM was pretty decent on the services side as well, and it's reintroducing the idea the Fed might have to go even further. Now, SocGen's taken another view on this. SocGen's saying in the last 24 hours, Subhadra Rajappa, thank you for this, that ultimately this reintroduces the risk of a policy overshoot, that this Fed has to go too far because they're using lagging indicators like the labour market to encourage them to do more.
Can they succeed? The distance from Sintra to IMF Morocco onto 2024, can they succeed without overshooting? I think by definition, any central bank has to overshoot. They just get it wrong at some point.
Looking forward to the guest lineup this morning. As Tom points out, this hour, Christian Horner of Red Bull Racing going into race weekend on this Payrolls Friday. Fantastic lineup of guests, including Nadia Lovell of UBS. Look out for that. A little bit later on this morning at about 9 Eastern time, we'll catch up with Mohammed Al-Arian of Rick Reader as well. So looking forward to hearing from those two. I think about 30 minutes after Payrolls.
Reader and Mohammed, it's really strong to talk to them. I think they're talking about an 11th F1 team between them.
Oh, they're going to put one together.
Larry Fink's doing Bitcoin, so why not do an 11th F1
Larry can afford it. Let's put it that way. Futures right now slightly negative on the S&P. We're down about 0.1%. In the bond market, yields creeping higher again by 2 basis points. I think we can call it 5% on a 2-year at 4.99 at the moment. On a 10-year, Tom, north of 4%. I think that was the first close above 4% on a 10-year post SVB, actually.
And we got disinversion. We went from 105 basis points, 2-cent spread. We got a less of an inversion, 95 basis points right now. And I'm sorry, to me, the 10-year real yield's the heart of the matter, John. This is like, Greifeld's doing the real yield now. You used to do it. I mean, you slummed off. You're not doing it. So Greifeld is doing the real yield Friday afternoon, and the answer is 1.80% on the 10-year real yield. Is a game changer as we go into jobs.
Katie's fantastic. Looking forward to her coverage a little bit later on this afternoon. Joining us now, Stephen Whiting, Chief Investment Strategist and Chief Economist over at Citi Global Wealth. Steve, wonderful to start the program with you this morning. Thanks for being with us. Steve, let's start with your expectation. 8:30 Eastern time, 2 hours and about 26 minutes away. What are you looking for?
Well, less than 497,000. I would just say that. But I think we should remember that the services sector had really a depression 3 years ago. We're not about to lose services jobs anytime soon. And it's had, I think, everyone's expectations, if you were bullish, bearish, hawkish, dovish, the labor market has outperformed everyone's expectations. It's outperformed the economy. And I think as investors, we have to think about how that will unfold in the next couple of years. I think the Federal Reserve is going to get its way one way or the other to get the unemployment rate up over the next couple of years. But there's not going to be some singular moment where we collapse in every industry. It's just not working out that way. And there's going to be a period in which the labor markets are not outperforming the economy, where I think the economy itself can recover. This period in which output has been falling, business investment has been down, and employment has been up. That's a very unusual period, as you said, breaking all the rules. So I think we're in for, again, another solid gain in employment. If the Federal Reserve wants to say we've got strong employment and above target inflation, they go ahead. And a lot of things worked out here in terms of the labor market in a favorable way. I have to look at that very differently from where output is.
You know, Steve, I think of Mankiw's 7th edition macroeconomics, and you own chapter 23, which is a linkage of all this econobabble into actually what it means for the corporate world. Where are you on the linkage of a better American economy into nominal GDP, which gets you to the animal spirit of companies and profits? Is that linkage still there?
I think it's there. I think it's muddied. I think we've got 2 years in all likelihood of below trend growth with industries just asynchronous. If you take a look at the manufacturing readings, the ISM at 46, we have inventories coming down. The pace at which orders have collapsed is slowing already. We're deep into a manufacturing recession, a mild one. Okay, I think single-family home building and multifamily are in different places. Travel and leisure is in a very, very different place in the economy. And these different moving parts, I think, will speed up and slow at different times. So we're going to end up, in all likelihood, with a forecast that looks quite a bit like the Fed's, below trend growth rather than collapse. And that's going to be the same thing for companies and industries. Right. But the one thing we shouldn't expect them to do is binge higher again. At the point at which the economy is, this has been sort of a job-full recession, if you want to say that, at least in the industries that are contracting. I mean, take a look at the construction industry has had a 20% loss, drop in residential investments, done nothing but hire more people.
Right.
I think we're going to end up with a jobless recovery on the other side of that. I think that's going to actually be good for asset prices once we get through this period.
Well, to your colleague in crime, Catherine Mann, now holding court at the Bank of England, or a guy named Hollenhorst who darkened the door yesterday here at our office. Do you notice Whiting can't come in? Hollenhorst comes in.
Oh, what's that about?
I don't know what that's about.
You want me at 6? Okay.
but Steve, I mean, Mann and Hollenhorst are talking about a higher rate regime. Everybody listening or watching wants to know, will that derail the game?
Look, I think there's been a lot of good news here in the financial system, at least relative where everybody thought it was in the month of March. You know, we're not seeing bank deposits flee the banking system at this level. If they continue to probe higher, there are some risks around this. We're not going to go through this cycle, for example, without some commercial real estate problems, as you probably always hear. But I think we will have an absence of very broad-based problems in the high-yield bond market. I mean, industries that normally drive this in a very, very cyclical way, like energy. I think we're thinking about $65 for the oil price as a trough here in a slowdown. GDP growth troughing over a couple of years, you know, at 1.5%. That type of environment. So from that perspective, yes, we'll have a higher real rates, and I think that that'll be an opportunity for investors. But let's remember, inflation that's gone from 9 to 4, and by the way, it's doing this with 8% inflation in shelter prices, which is just a figment of the past. I think headline inflation is going down as rapidly as it ever has after kind of a disruption and upheaval in the economy like we have had. And it will continue to go down.
Steve, I'd like your view as well on the Treasury market, the 2-year versus 10-year, that curve, deeply inverted, backed away a little bit over the last 24 hours, back to about negative 94 basis points from triple digits over the last week. Jim Reed of Deutsche Bank said this, Steve. Let me share this quote with you and see if you agree with it. He said, the longer the inversion remains, the more likely the animal spirits will continue to drain in the background and the downturn will happen. It's hard to believe banks will reopen the spigots with the curve so inverted. Steve, just how important is that curve and the inversion that we witness at the moment?
No, look, it is important. It's, again, giving a pretty high reward for shuttering down and not investing. Whether that is in financial markets, whether it's in the real economy, it's having effect on banking. But again, it's not in a situation where the entire economy is going to be dependent, again, on the curve. I think what we're seeing in terms of tightening of bank lending standards is very meaningful to restrain growth, but it's not really going to shut down parts of the economy that are still rebounding from a horrendous shock 3 years ago. You don't go through a period where services employment, falls by 25 million and just say, well, let's start that all over again because of this inverted curve.
I want to build on that just a little bit. Next week, CPI. Inflation just around the corner. We know later this morning we have payrolls. After that, JP Morgan earnings season starts as well. For the bank, Steve, for you and the team, what are you going to be focused on as those earnings start to pour in?
Well, it's this remarkable dispersion in valuation and whether or not earnings data will really continue to power that. Look at NASDAQ at 27 times expected earnings. And of course, you can find some stocks that are powering that higher. You're taking a look at mid caps and small caps, the profitable portion of that market at 14 times. Now, that's just the United States. Go outside the United States, it's an 11 times market. That kind of valuation dispersion, we've got to start looking at it and saying, even if we expect below trend growth in the next couple of years, right? How about so much of the world equity market that's trading like we just had a mild recession?
Steve Whiting, is cash, I've never said this. Well, no, that's not true. I've never said this in 18 years. Is cash attractive at a 6% rate?
At a 6% rate, it's certainly a lot more attractive than it has been, but it's not sustainable at 6%. You take a look at the Fed's own forecast for the long-run normal policy rate, 2.5%. You say, oh my God, how could they possibly get there? Well, they spend a long time at zero. I don't expect zero again. But the long end of the bond market, you said, what do you think about the Treasury market? It's hard to find a really good part of the Treasury market that's undervalued relative to some other point, because it pretty efficiently prices in that we're going to have to get this, it's very undelicate to say, this pig through the python, right, of getting this inflation rate down, getting this economy past this upheaval that we have had in these shocks. And when we get there, we're going to have a lower inflation rate. The Fed's going to be sure of that. And I really don't believe that we're going to be doing 5 or 6% cash as a normal rate once we do that.
The pig through the python. You not heard of that, Tom?
Is that?
No.
Is that? I don't know. Is that like a City University of New York? Like that's like a Steve Whiting thing. He learned that probably, when you get your PhD in the island of Manhattan, that's
like a pig through the python.
Pig through the python.
Steve, thank you.
That's great.
For that as well. Steve Whiting, a City Global
It's
Wealth.
fabulous.
Going into payrolls. Payrolls, 2 hours and about 20 minutes away. We're looking for a number close to 230K based on our survey here at Bloomberg at the moment. Yesterday, before ADP, that number was 225. Mike McKee telling me about the whisper number,
Yeah.
It's been creeping higher for obvious reasons after that ADP report just yesterday.
Yeah, Mike McKee always helping on this. This is an actual terminal function. I didn't know this. Did you know this?
You can contribute to it, yes.
WHIS GO. You actually type it in the terminal. Good morning. If you have a terminal in your car, keep your hands on the steering wheel. And the answer is we've ballooned out from 260,000 suddenly to 275,000. And what's important here, for those who don't keep score on this at home, we're supposed to be back to like 150 south to begin to show that labor tension the chairman wants.
Yeah.
We're miles away from that. I stand corrected at 8:30 when we get 60,000. Zentner looks brilliant, but we're miles away from where Chairman Powell wants to be.
Ellen Zentner, Morgan Stanley, later this morning on this program, looking for 270,000 on payrolls a little bit later. Coming up in the next hour, fantastic conversation lined up with Mark Cabana of Bank of America. Tom, on this yield curve inversion in the bond market.
Great.
Looking forward to that.
Can I get a BAP, please, this time with sausage?
You want a bacon BAP? Or you want a sausage BAP? A
yeah.
sausage roll?
Like Greer's, what they do. Greg's.
Is this going to be the conversation with Christian later?
It is, yeah.
Christian Horner of Red Bull Racing, just around the corner.
We seek to diversify and not to decouple. A decoupling of the world's 2 largest economies would be destabilizing for the global economy, and it would be virtually impossible to undertake.
There is a new buzzword in international relations. That was Janet Yellen, the US Treasury Secretary, speaking in Beijing in the last 24 hours, touching down in China for conversations over the last couple of days with her counterparts in the Chinese government. For a while now, we've been using this phrase, Tom, de-risk, not decouple, and now that new D word is diversify. Apparently that's more palatable, diplomatically speaking.
What was the committee that made that statement for Secretary Yellen?
The same committee on the FOMC.
Yeah.
You sit around a table coming up with new words.
I had the clearest memories on a lovely summer day when Henry Paulson tried to jumpstart an active dialogue with China about something as prosaic as trade. And we're just beyond where Paulson was, and Yellen has to traipse through defense issues, Taiwan issues, historic issues, present issues, and then all the tech babble on top. I don't think we still know what the balloon was doing, do we?
I think we've got a decent idea. And you also know, Tom, in her heart of hearts, she doesn't want tariffs.
Yeah.
That's not the kind of individual that likes tariffs at all.
No, I think within the canon of international relations and economics, everybody's still very much anti-tariff, whether it's Canada and the U.S. or China and the U.S. John, I want to slip this in. This weekend, folks, I've had a lot of requests for summer reading, and I'm going to go back to some of the chestnuts, which John really has to do with this trip. This is Robert T. Kaplan's Marco Polo's World. And it's a great overview of the cauldron of all those nations as we diversify where? To Vietnam?
Is that your book of the summer?
No, it's not my book of the summer. It's one of the oldies, but Olivier Blanchard. Gotta be. It's about R. Starred, John Williams. Ken Rogoff says no, it's going to be a higher R. Starred. It's sort of wonky. It's a
When
wonky
do we
book.
do book of the year?
Book of the year, we're slipping in. Last year we did it very early. Angela Sten on the shock of Putin's invasion of Ukraine.
Right.
Unseemly early. I was really wrong on that. Although it's a great book. But this year we're holding off on Book of the Year.
You're saying you were wrong on the book you selected as Book of the Year.
I may do one on the tots, but, I'm thinking Formula One. I mean, Red Bull.
Okay, cool.
We can do a coffee table book.
Horner.
That would be good. Let's save ourselves with Edward Mills. Ed Mills, with decades of experience in Washington, he holds out the shingle at Raymond James on Washington policy and joins us this morning. Ed, it's the one common ground in Washington. The Republicans hate China, the Democrats hate China, and we're being lectured to diversify. How does Capitol Hill diversify with China?
Yeah, Tom. So this last week, where China is seeking to restrict some of the critical minerals that are needed for semiconductors and other high technology, that supercharges Congress in their agenda to do permitting reform. It supercharges them in the need to diversify supply chains out of China, and diversifies the need to make sure the critical minerals that the Biden administration, they've put out 50 critical minerals, about half of them, more than 50%, we get from China. And so there are other places in the world where we can get those. Last couple of years, we saw huge change in the semiconductor space, massive investments, massive subsidies. Look for that diversification to go into critical minerals, go into energy permitting reform later this year.
Well, let's take the tangent here. It's Friday. We're allowed to do things on Tangent Friday. And I'm going to go to where time stood still the day I realized China took over all the cobalt in Congo as a generalization. It was like 8-9 years ago where China decided to own Africa metals, if you will. The zeitgeist right now, this is The Economist did a great treatment on this, of nickel nodules on the floor of the ocean. Is China going to beat us to the floor, the seabed of the ocean to take nickel because Congress can't get their act together?
If they do, that's even more pressure, Tom, on Congress acting. One of the big concerns of the last several years, you mentioned, part of this decoupling is which side is each part of the world on. The One Belt, One Road initiative out of China was looking to deepen ties with Africa, deepen ties with parts of Europe. That's part of why they don't like that we pressure China as much as we do. But anytime China identifies something as they are going to be first in the world, that's when Congress gets involved. And so to the extent that they want to be first in the world at the bottom of the ocean, we're sending subs.
See that Ed Mills read my book, Marco's Polo's World by Robert T. Kaplan.
Yeah.
I mean, that's what it's about. It's about belt and suspenders and all that. It's the way it works.
Book of the summer.
A couple of years ago.
And let's build on this. The
movie's
Europeans
coming out Memorial Day.
Where do the Europeans fit into this?
Yeah, so what the Europeans, so far, for the most part, the Biden administration has been able to keep the EU and a lot of our allies on the same page. What China always tries to do is to divide and conquer. And so what we saw is some of the restrictions first were announced by the EU, and then they were targeted against the EU. They want to see if there can be a division. You saw a couple of months ago, Xi and Macron meet, and it almost seemed as if Macron was entering into that division and kind of questioning, but that's probably more about making sure China stays out of the war in Ukraine and not support Russia. So I'd always watch for China to very craftfully try to find wedges in relationships. And on trade issues, they think they have a wedge with the European Union because of their investments in Europe, because of One Belt, One Road, and because of the trading partnership the EU absolutely needs with China. And so the diversification is better than de-risking from a diplomatic perspective for Janet Yellen to say this week.
Ed, from the US perspective, who is the weak link right now in Europe? Traditionally, over the last 10, 20 years, it's been Germany. Is it France? Is it Italy? Who is it?
I'd say it's a combination, but I would put France because of those diplomatic relationships and some of the issues between Airbus and Boeing. Italy kind of has been more and more kind of the poster child, and Germany just as their size as an economic engine. But I think they look at them kind of collectively and individually trying to find those wedges. You saw kind of U.S. companies meet with kind of Chinese officials over the last couple of months. Chinese officials largely have figured out they can't divide and conquer too much within the Biden administration. So can they divide and conquer with U.S. businesses, putting pressure on U.S. officials to not go as far as Congress or the administration wants? I always look to see kind of how successful they've been. Right now, they're not. But they are not going to stop trying.
How do you think they're going to change that? And I mean, in the United States, we can see how successful the Chinese government has been with companies like the Walt Disney Company. Pick a bank, ask them about the Chinese Communist Party, and they're very unwilling to say anything negative about them. And if you pick a bank and ask them to say anything negative about the US, they're willing to go there on social issues. And how do you think the US and this administration, and future administrations for that matter, manage to get corporate America on side with their view of the world?
Yeah, so I think one of the big changes that hasn't had enough conversation is that forever we've always thought about having all sorts of restrictions and sticks in the relationship. Now we are moving more and more towards carrots. So when we look at the Inflation Reduction Act, there's massive subsidies to diversify supply chains out of China and build it in the United States or with a U.S. partner, especially within North America. We saw in the semiconductor space, we're not trying to just put restrictions on semiconductors. We're seeking to build capacity, massive U.S. subsidies. So you get U.S. businesses along by not giving them restrictions, but by giving them support in carrots to build in the United States and carrots to diversify. So incentives matter. And the more incentives we give to U.S. businesses, that's where you see that shift happen, John.
Ed, thank you. It's going to be really interesting to see how this whole issue progresses over the next few years. Ed Mills there of Raymond James on the latest. So we've had Blinken, we've had Yellen this week. Yeah. Let's see if it's Biden Xi next.
To me, it folds right into the American economy and frankly falls into our labor economy as well. This codependency, as Catherine Mann calls it, is just foundational. Hasn't disappeared.
There's a conversation over the last few months this year that I remember it stands out. It was with Sarah House of Wells Fargo on the last mile of the effort to get inflation back to 2%. Sarah House of Wells Fargo, up next. Right. Payrolls data in the United States of America, 2 hours away. Looking forward to that. 230,000 is the estimate, the median estimate in our survey.
Threads.
A little bit higher than the expectation. Yesterday, post-ADP, which was a blowout jobs report, a lot of people starting to pencil in maybe a higher number. Here's the price action going into that. Equity futures shaping up as follows on the S&P. On a session, we are negative by not even 0.1%. On the week, we are down by 0.9% through Thursday, a shortened trading week, the holiday week, Tom, post-July 4th, but ultimately a bit softer over the last couple of days.
Yeah, we need to emphasize here into this jobs report and frankly a lot of other data, this data screen doesn't look like it looked 10 days ago. It's radically different in the fixed income space. And the 10-year real yield just printed a true 1.80%. How many people 15 days ago would have suggested that? I think next to zero.
We're talking about highs we haven't seen since the financial crisis. So let's talk about the bond market. Chop it up, 2-year, 10-year, 30-year, 2-year right now, just south of 5%. Going through that level yesterday. In fact, yesterday, 5.11 at one point. Yesterday on the 2-year yield. That's a new high for this cycle. On a 10-year through 4%. This is the latest from SocGen. The strong labour markets, a resilient consumer and sticky inflation argue for higher policy rates, but also increase the risk of a policy overshoot. While the momentum-led sell-off could continue over the near term, they see this as an opportunity, Tom, to reignite, reinitiate longs at attractive levels.
Well, that's going to be the strategy here. And boy, will there be a lot written after the jobs report today at 8:30 and on through the weekend, and the recalibration into July in Q3. It's going to be something to see. Sarah House joining us right now. Sarah House is with Wells Fargo, and we get an update. Sarah, I hearken back to the memory of how Wells Fargo absolutely nailed double-digit unemployment. When it moves quickly. Do you people, are you at a place like 06, 07, 08 where suddenly unemployment rate could move higher?
I don't think we're quite there yet, so I think that's probably more a move we're expecting early next year. I think in terms of today's unemployment rate, actually looking for a slight dip, just given what we saw in some of the household numbers of employment, what some of the participation rate trends, and just kind of how rounding shapes up, where ultimately we're still looking at a very tight labor market right now, but I think there's continued pressure ongoing when we look at the stance of monetary policy.
Is the very tight labor market a surprise to fancy PhDs at the Federal Reserve? Are they as surprised about this as it seems the market is?
I think the degree of how strong the labor market remains has been a pretty broad surprise. I think you can see that whether it's in the Bloomberg consensus expectations of non-farm payrolls over the past 14 months, consistently undershooting, and I think you can see it even in some of the more recent data. If you look at that U.S. labor market surprise index, it's at an 11-year high. And so I think while we are seeing signs of the labor market cooling, it's much more gradual and much more of a glacial pace than I think what really many expected based on just how fast the Fed has moved.
Sarah, a little bit later this morning, we'll catch up with a peer of yours, Ellen Zentner, over at Morgan Stanley, and she's written about labour hoarding. And you've touched on that issue too. Can you build on that just a little bit more for us, Sarah? The willingness of corporate America just to hold on to their workers a little bit longer. Are you seeing evidence of that?
Well, so I think given the severity of the labor shortages we've seen over the past 2 years, but also the severity that we're seeing even in 2018, 2019, I think it does set a higher bar for businesses laying off workers even as they see output decline. But I think it's still too early to tell to what extent we'll see that. You're maybe seeing some hints of it in terms of like the average weekly hours numbers, particularly in sectors like manufacturing and transportation, which have seen their work week drop below where it was prior to the past downturn. And so I think you're seeing hints of it, but it's really more of a time will tell. And we really, I think, need to see that more persistent drop in output to get a sense of to what degree businesses are holding on to workers. We see some degree of labor hoarding in every downturn, but ultimately, usually midway through the cycle, push comes to shove, you do see those layoffs begin to mount and that hoarding go into reverse. So I think we have to be cautious in how much it can insulate that next downturn.
Morgan Stanley's gone as far as saying a soft landing for the US economy is likely, and the resilient labour market is central to their narrative. Sarah, do you have a base case on the landing, whatever that might be, in the next few quarters, the next few years?
Yeah, so I'd say we're still pretty cautious in terms of whether the Fed can pull off this soft landing, which in our view means getting inflation down without a recession. So we're still expecting a mild recession in the first half of next year. As ultimately, I think it will take a meaningful drop back in demand, I think, to get inflation back in the bottle and keep it there for good. So I think there's certainly some disinflationary momentum building, but in terms of getting inflation all the way back to 2% 2% and essentially sticking that landing, I think we are going to have to see, I think, some weakening in overall demand that's associated with the recession.
Sarah, you've led the debate on this. You've done a great job. John's mentioned it a number of times of getting out front on the stickiness, the ability to get from 4% down to 2%. There's a new trend here. I'm going to give credit to Jim Bianco, folks in Chicago, who's suggesting that not only do we go down to a Sarah House level of 3%, but we turn around and actually we could see an increase in inflation out there. Is that in the realm of possibility?
I think given that we've been looking at inflation running 2x the Fed's target for essentially 2 years now, I think given that possibility for inflation pressures to become more entrenched, for that price setting behavior to be different now than it was prior to this episode, I think it certainly opens the possibility of that risk. I think we continue to see some deceleration as we move through 2024 and I think even further into 2025, but I think that's reflective of the risk that this is not going to be an easy or short battle. There's still a long way to go in terms of bringing inflation back down to the Fed's target, and remains to be seen how much resolve the Fed ultimately has.
Beneath the headline data, okay, what is the data that matters today at 8:30 beneath the headline data? What will you look for?
So I think the labor force participation rate and what's going on with labor supply is going to be hugely important. So this is probably the most important element to the Fed pulling off that soft landing. It's being able to get that labor supply, reduce those wage pressures and that inflationary pressure coming from the labor market, but still getting people employed and having money to turn around and spend. So that's going to be one number that I'm hugely interested in. And of course, just what we're seeing in terms of the average hourly wages, given that inflation is still the foremost concern among the Fed and how that's affecting the inflation picture.
Can we finish on the number everybody was obsessed with yesterday, the ADP report, and the close to 500,000 jobs added? Sarah, I'm sure you took so many calls from clients about that yesterday. What did you tell them?
I told them that since the ADP has redone their methodology, it's undershot the NFP number 7 of the past 10 months by an average of 75,000. And so we're due for an overshoot in ADP. So we're expecting an NFP gain of 260. So notably weaker than what we saw with ADP, but still definitely a robust number for hiring.
So not looking for 500K on payrolls later, right?
Not quite, but still a very strong number.
Sarah House of Wells Fargo. Sarah, thank you. On the latest on a jobs report, that jobs report coming out a little bit later this morning. For those of you interested in some of the estimates, the big estimates on the big banks, from the big banks on Wall Street.
Have they changed much recently?
Here they are. Morgan Stanley, Ellen Zentner is going to join us later, 270. We just caught up with Sarah House of Wells Fargo, 260. Goldman, Jan Hatzius, 250. Mike Gapen over at Bank of America, 250. Ferroli, JP Morgan, 200. Citi's Andrew Hollenhorst. This is interesting. Bottom of the pile, 170, but still thinks we get 25 basis points from the Fed later this month and 25 again in September.
The standard error here is a big deal. This is a math thing you flunk on statistics exam. It's 1 over the square root of n, and n here is 150 million. So it's 1 over the square root of 150 million, which means, it's like the width of the Formula One race in Barcelona. It's like way too wide. It's boring.
You upset with that track?
Yeah, I'm very upset.
You don't
with
seem
Spain.
happy with it.
Spain. I'm upset. The cob that I had just now, the sausage cob,
bacon
was
roll.
wonderful. But anyways, the error here at 8:30, I think, is underplayed. McKee knows this stuff cold. Can I bring up somebody that I saw in our famous food court? I sit in the food court every morning at 10:05. Sort of decompress.
I pass you there. Yeah.
It's like yoga. I find my inner self there.
Sure, I do the same thing.
I do it with 2 bags of Cheez-Its. And the answer is Tim Ash comes up to me with Blue Bay Asset Management. Tim Ash is like one of my heroes. He's like really, really good. He's got the chart of the day. On radio, all you need to know is it does look like an Elon Musk moonshot. It's all there is to it. It is the generic 2-year United Kingdom bond. It doesn't look like the American bond. It's straight up in the vicinity of 6%, 5.5% around it. John, what's the level of tension here of do something from a Governor Bailey who said, look, we're not going to declare victory? They're miles from declaring victory right now, aren't they?
Well, when you say do something, what do you mean? Do you think this is a problem right now, or is this part of the solution?
Tim Ash says they need an anti-crisis program. That's where he is. They need to do something in the United Kingdom
on the fiscal
right now.
side or on the monetary policy side?
I don't read the reports. I just look at the headlines.
Well, I think we should go through the levels. I've compared and contrasted where we are now compared to where we were at the end of September. At the end of September, you've got Liz Truss and number 10 Downing Street trying to do some pro-growth stuff, some tax cuts, and everyone going, you're crazy, what are you doing? And yields are spiking to 470. We've got this financial instability. Bank of England's in a corner, has to start doing things with bond buying again in the gilt market. And here we are. We have taken out those levels and some. At the end of September, we were at 470, something like that at the highs. And right now, Tom, we're looking at 550. And back then, sterling was on its knees, 103.50. Sterling's having a little look at 130. This moment
with a buoyant
right now,
GDP.
This moment now in the UK is very different to the moment we were in back in September. We just don't have that financial instability. Maybe you think that will come, but at the moment it's absent. And you don't have that policy risk on the fiscal side that was very evident, very apparent in September. You don't have that now.
And I think Christian Horner would say this too, the economist Christian Horner, he would say, what are we upset about? The UK has a buoyant economy, it appears, way away from recession.
It's surprised to the upside, to be precise.
The United States has a buoyant economy away from recession. These are good things. And so rates elevate higher. I mean, that's what they do.
A double-digit food inflation, not a good thing. And these are the issues that people have got. Tom, if you're a saver, and a great conversation with someone about this yesterday, and I'll be talking about it later with them too. If you're a saver right now, you have a lower marginal propensity to spend. So you're getting higher interest rates, great. Tom, fantastic. But if you're a debtor right now and you're struggling and you've got to refinance that mortgage because you don't own that house outright and you've got to do that in the next 12 months, these are really tough times. And this speaks to the idea, Tom, that for one person in America, things are great. Got high interest rates on a lot of cash. Maybe they locked in a 30-year mortgage at nothing. Maybe they own their home outright. For the debtors of this world, Tom, they're really struggling.
You're talking
right
my
now.
book. You know that I have trouble with aggregated macroeconomics, and I understand institutional authorities have a responsibility to do that. But off the pandemic, this is wildly disaggregated. I mean, you and I are looking at Austin F1, and frankly, you know, Red Keeper of the Amex said, we just can't do that. You got to go to something cheaper in Europe, and, you know, we'll have to do that.
Alarian's coming up later. And
you just completely ignored me there.
I know, as you often do to me. Mohammed's coming up later, and he thinks there's an over focus on the demand side and doing things with monetary policy and not enough focus on the supply side.
Do you think Mohammed's going to Silverstone?
I mean, I don't think so. I mean, we can ask him. We can ask him.
He's got to go with Aston Martin.
Can I just say, I love that you're into F1 now. I love this.
I'm loving it.
I love that Christian Horner's coming up with Red Bull in about 3 minutes, and I love that you're in a position where you actually want to lead that conversation. I'm all wound up.
I want to talk to him, folks. For those of you that don't know this racket, think of the guy with the Los Angeles Angels, Ohtani. The guy driving for Christian Horner, my amateur take is he's like Ohtani. This guy starts with a V. What's his name?
Max Verstappen.
Verstappen is just, it's odd how extraordinary he is.
You have drivers like that now and then. Max is just...
Was Schumacher like that?
Sure. Yeah, just on the edge, willing to take that car to a place where other people aren't. It's not just about the car, it's about the person in it. I think we like to overplay the dominance of the car, and Red Bull Racing have done a phenomenal job over the last few years.
But they've done okay.
The guy driving that car, Max Verstappen, he's willing to push that car in a way that other people aren't.
We're going to do this. It's Jobs Day. We're going to digress in the summer here. We're trying to do that. English football, I don't understand the money of English football. The gazillions being spent. I just don't understand who's getting what
speaking
money.
Of dominance in world football right now, English Premier League
Maria
is just
today,
on
we had to
another
medicate her yesterday. Something about Real Madrid.
What did she say?
They signed somebody at Real Madrid, and Maria went mental. I mean,
I haven't spoken to Maria for a long time.
I know. We've got to
sort that out.
It's really hard to get to her. Her entourage, it's just brutal. It's the worst.
Up next, going into race weekend in Silverstone in the UK, Christian Horner of Red Bull Racing on Bloomberg Surveillance.
Inflation itself is getting close to bottoming this cycle. We think it's going to be very difficult for the Fed to get inflation below 3%.
If inflation rate bottoms at 3 and starts drifting higher, the Fed's going to find this unacceptable. And that 2 rate hikes that we have priced in for the rest of the year will happen if not 3.
Even if the Fed does sort of get rates up to say 5.5% or even 6% and keep them there, unless you think inflation is also going back up again, then that policy will become just even more and more restrictive, and they're going to have to unwind those rate hikes very quickly. Otherwise, they will collapse the economy.
What a range of views there. Tom Tsouras of Strategas, Jim Bianco of Bianco Research, Dom Constam of Mizuho Americas, setting the stage for payrolls coming out in about 1 hour and 43 minutes time. Looking for something close to 230,000 in our survey here at Bloomberg. Yesterday, that number, before we got the ADP report, was something close to 225. That's crept a little bit higher. We get this so-called whisper number. Let's talk about that whisper number now with Mike McKee of Bloomberg. Joins us around the table. Mike, that number just around the corner, the whisper number, talk to me about it. It's creeping higher.
Well, it's not creeping higher. It's shooting higher. It went up to 275 from about 260 yesterday because people saw the ADP report, and it's a bit of a herd mentality. However, it has been sort of an effective strategy to bet on a higher number for the last 14 months because jobs have come in higher than the Bloomberg consensus for 14 months in a row.
Are they quality jobs? This call brought up the dining room table last night. Are they quality jobs, or are we just doing, waitresses, may I help you jobs?
Well, if you look at the ADP report yesterday, it was mostly waitresses, may I help you jobs. However, maybe the definition changes a little bit because we've seen a significant increase in pay for people at the lower levels, and on a percentage basis higher than for people who have so-called high-skill jobs.
In the zeitgeist right now is this new phrase. I'd love your response, Mike, with decades of experience. Rich, I can't even pronounce it, rich session, where it's the upper quintiles of people that are feeling job angst. Do you buy it?
Well, yes, in a certain sense, because a lot of where the layoffs are happening have been at tech companies and finance companies who are very cyclical. They staff up when the economy is starting to grow quickly, and then they quickly get rid of people when business falls off. However, we're talking people who aren't going to be suffering as much as the people at the lower end, and so it's a little harder to discern an overall impact on the economy.
I look at wages. A lot of the economists are saying they're going right beyond non-farm payrolls and the rest of it. Explain how Mike McKee sees our wage increases and our inflation agony right now. How do you sort that out at 8:31?
Well, there are a lot of different wage measures. Today we get average hourly earnings, and what's happened is we're starting to see average hourly earnings meet or exceed the inflation level. For a long time, workers have been losing ground because the inflation rate was higher than what they were getting in additional cash. Now we're seeing wages rise. 4.3% is 4.2% is the forecast for today, average hourly earnings, and inflation's running at about. Well, we're expecting next week to see it in the 3s.
Mike McKee, thank you so much. We really look forward to 8:30 this morning. He does it better than anyone out there. Alex Kalonakis for Autosport,
tell me more,
and for the New York Times, says from Lewis Hamilton, he's with the evil Mercedes team. And Sir Lewis?
It is Sir Lewis.
It's Sir Lewis. Sir Lewis says it has the best layout for our American audience. And I grew up in the fumes of Watkins Glen. Explain to us what Silverstone means and go to Christian Horner here.
We can do that right now. We can catch up with Christian Horner, the team principal for Red Bull Racing. Christian, wonderful to catch up with you, sir, going into race weekend in Silverstone. Can we start there, as my colleague Tom pointed out? Just how special is this race, this circuit, for you and the team?
Well, look, it's one of the best circuits on the tour. It's fast, it's demanding, it sorts the men out from the boys. It's a big challenge, and it's old school. I mean, this track goes back to just after the Second World War. So an old airfield with a perimeter road converted into a racing circuit that has developed over the years. But it's one of the big tests for the drivers and the teams.
Max was absolutely dominant last weekend. There was this amazing moment at the end of the race with a couple of laps to go. He came in for a pit stop just to get the quickest lap. Christian, can you describe the guy that you're working with every single day? How special is Max Verstappen?
Well, I think what we're witnessing at the moment is a sportsman that's just really at the top of his game, and he's a joy to work with, and he continues to surprise us with just the levels that he's reaching, and the height that he's hitting. So as I say, nothing is nothing is. He continues to surprise us at the moment, but he's in the form of his life, and I think there's more to come.
Christian, I think Americans are fascinated by this. I look at the wonderful coverage Sky Sports is doing, and basically they forget about Verstappen 5 minutes into the race to look at all the Netflixy sub races and all that baloney. We have in America a guy for the Los Angeles Angels in baseball named Ohtani, who's once in a generation. Is Verstappen like that?
I think, look, we're in a halcyon period of Formula One. We've got Lewis Hamilton, the most successful driver of all time, out there. We've got Fernando Alonso that's doing it for the old guys. And, we've got this emergence of Max Verstappen. And I think only in time will history judge just how good he is. But what we're seeing at the moment is certainly something pretty special, particularly with the results that he's ratcheting up.
Christian, talk to me about how, from a manager's perspective, you maintain harmony within the team. When he took that point for the quickest lap last weekend, that was taken away from Checo, his teammate within Red Bull. Christian, can you tell me as a manager how you're maintaining the harmony when you have to provide the resources for someone as dominant as Max and maintain the confidence of his teammate?
Well, I think he's just dealing with openness and honesty. And I think, look, Max deserved or earned himself the opportunity to have a go at that fastest lap. He created a pit stop for himself. He was going to have a go at it on old tires, and for us it was actually less risk to put him on a set of newer tires and take the pit stop. So he earned himself that right, and I think the relationship between the two guys is strong, and the most important thing is that they talk to each other. They communicate. When there's an issue, they talk about it. We get it on the table and get it addressed.
Can we expect Checo to be racing for Red Bull next year then, Christian?
Yeah, he's got a contract. He's with us till the end of 24. So, and we're happy, irrelevant of the contract. We're happy with the overall performance of him. He's had some difficult Saturdays recently, but his racing's been great, and hopefully the confidence from that podium in Austria is going to put him back on the pace here on Saturday.
Let's talk about someone else on the grid who's unhappy. Lewis Hamilton, unhappy with the dominance of Red Bull. Unsurprisingly, Christian, he's had some recommendations on what they can do about that. Maybe we can set a time limit for when we start to plan for next year's race car. Christian, what's your response to people who are fed up with the dominance of your team?
Well, look, it's flattering in many respects. The sport goes in cycles. I mean, Mercedes, how many years did they dominate and nobody got anywhere near seeing them for about 7 years? So, look, we're performing at an incredibly high level. The team is doing its job. And the others, will be putting a target on us, and they'll be trying to catch. And I think with stability of the rules, that the field is going to converge. It's only a matter of time. So, I think trying to get everybody to start to design their car at, a start date would just be impossible to manage and police.
Yeah. Christian, our producer, the guy that tells us what to do every day, grew up in Western Australia. So he says, we're not doing the interview if we don't talk about your third driver, Daniel Ricciardo. I think that people looking at Daniel Ricciardo in America are saying, what does this guy do? Do you want to retain a third driver like Daniel Ricciardo? Or is it a good feeling for Red Bull if he goes off to someone else, as is rumored?
Well, look, I gave him that chance because I thought Formula One still needed Daniel, and I think that he's still got more to give. We know how talented he is. He just needs to rediscover his form and his mojo, which he seems to be doing, certainly in the virtual world. And he's testing our car in the real world on Tuesday and Wednesday of next week. And we'll start to see where he's at as in relation to the race drivers. So it'd be great to see Daniel back on the grid next year, even if it's not in a Red Bull car.
Christian, a sensitive issue which we see in the danger of Formula One and all the safety efforts that are made. There have been 2 really difficult deaths in Formula One, including a tragedy recently, I believe, in Belgium. What do you do day to day, tick by tick, to make the sport safer? What's the next thing to make it safer?
Well, look, I think the FIA do a great job in terms of the safety of these cars. It's just, compared to where they were just even a few years ago. If you look at Romain Grosjean's accident in Bahrain, I think that a human could actually survive that is beyond belief. But, you can always do more, and the FIA are constantly pushing us, with the cars. But also now the circuits. I think there's circuits that we need to look at because we can only take the cars so far. But I think there's still more that we can do as a collective with the FIA on certain circuits.
There seemed to be, I was baffled last week watching every minute of it and really, what your team did. And I look at, I guess it's called the stewards, where the track isn't working out and people are going off the track and there's 1,200 violations. We don't see that in American sport. Are we going to see that again at Silverstone, where the quality of the driving is so good that the track doesn't fit the excellence of the drivers?
Yeah, hopefully not. I think that was something that needs to be addressed moving forward. I think the problem is it was two corners that are inviting the drivers to go out there, and of course they can't see the lines. They're driving by feel, and I think that if there was a piece of gravel strip there or something like that, they wouldn't go near it. If there was a wall there, they certainly wouldn't go near it. So I think that there's things that can be done to improve the situation. Hopefully it won't be an issue here, but you've got to stay in the lines.
I do want to finish on safety and the track. Christian, there are some worries that maybe we have some protests. The climate change protesters that we've seen protest various sports in the UK over the last few years. Are you concerned about that over the weekend? What have your conversations been with the FIA over the last couple of days and your own drivers going into the weekend with regards to that?
Well, look, it is a big concern because, look, you run on a cricket pitch or a tennis court, there's only a bat and a ball out there. You run on a Formula One track, there's 20 cars going around at speeds of close to 200 miles an hour. And from a safety point of view, it is unimaginable or unthinkable that people would put themselves into, and the drivers at such risk. So I really hope that nobody does anything stupid this weekend. Formula One is taking sustainability and is pushing that message and driving with fully sustainable fuels that we have coming for 2026. We're doing more than any other industry to champion that, and I'd be really disappointed to see somebody try and upset what is going to be probably one of the biggest sporting events on the British calendar this year.
Christian, I've loved our conversations. We've loved our conversations. Let's continue them. Good luck for the race weekend. As a Ferrari fan, you know that I don't quite mean that, but good luck.
Oh, I do. Good luck. I mean it this weekend.
Christian Horner of Red Bull Racing. It's been absolutely dominant.
How do you say that's rude?
Absolutely dominant, Red Bull. Every single race. It's been phenomenal to see. It's not just about the team, it's about the driver. Max has been at another level, TK, really has.
It's like Otani, but on an individual, that hyper-focused, you're the driver basis. The thing I got out of that, folks, as a complete amateur, John Farrow, is how they can't see the track. When they go off the track, they can't see.
Such limited vision.
I was not aware of that.
Looking forward to the conversation we have coming up for you in just a moment. Mark Banner of Bank of America. You did better than okay.
Okay, good. I'm
loving your interest in Formula One.
I was up all night,
Equity futures slightly softer here, negative 0.1% on the S&P 500. The jobs report just around the corner. The number in our survey, 230,000.
We continue to believe that we're going to see a global economic recession.
We can get a soft landing, fantastic, but a hard landing is very much still on the radar.
We do think that the risk of recession has risen. I do think that the Fed is going to continue hiking rates.
Given this price into the market, it will take a lot to derail a hike.
Our inflation forecast is strong enough on the downside that they don't need to hike again.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Payrolls Friday, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. Your equity market just a little softer going into that payrolls report, 90 minutes away. And our survey here at Bloomberg, the number we're looking for, 230K. In the previous month, 339,000. That estimate, Tom, just creeping higher after some dominant blowout numbers we saw just yesterday in the ADP report.
Maybe it was going to be a sleepy July Friday. That all ended 72 hours ago, and then with the vengeance with the ADP report yesterday. Chairman Powell is going to be briefed on this by the fancy people at the Fed, John, with a 1.80% real 10-year yield. You got a 10-year nominal yield of 4.06%. I have a print right now of 5% on the 2-year yield. The linkage of bonds into this jobs report is tangible.
2-year, 5%. 10-year, 4%, 4 handle on 10s at the close yesterday, I think, for the first time post-SVB. Had all that banking stress, Tom. Yields dived. We're talking about a credit crunch, a hard landing, and here we are a few months later, not even talking about financial instability when we have these central banking conversations.
This is really well taken, and there was some fancy work. I can't even keep up with it last night, reporting on deposit flows and money market flows. Mark Cabana is going to join us, who's smarter at this than I am, and the answer is...
Smarter than us both.
Yeah, but the answer is, John, is I don't think that problem's gone away. When I look at where yields are, and I remember the disintermediation of money market funds a zillion years ago, why can't that happen again? I'm watching money market fund flows.
Tom Constant agrees with you over at Mizuho. He thinks it's already started. The process has, Tom, and ultimately we end up with tighter financial conditions, tighter lending standards, and softer growth. Other people are pushing back. The division at the moment, Tom, is just amazing. We spoke to Tom Tsouras Strategas earlier this week. He thinks that inflation expectations for this cycle are bottoming, that they're going to tick higher again, that inflation's sticky.
Well, this
Fed's going to have a real challenge. That's one view. Other people taking completely the other side.
Give me credit for this. I coined it disinflation. That's where Bianco and Tsouras are as well. John, I got to say good morning, everyone worldwide. The reach that we have, we say good morning to Belgium and the Flemish landscape, is they were bedazzled, John, by your knowledge of Mr. Verstappen.
Would you like to share the tweet?
Have you been to Fleming? Is that what it's called?
To Belgium.
Belgium.
I have not been to Belgium.
It's supposed to be gorgeous. It's like,
Max's mum is Belgian, apparently. Father's Dutch. And we all know who Jos Verstappen is because he was a racing car driver.
Yes, we all know that.
Before.
Mark, help me here.
So a lot of people assume he is Dutch, but also I think that the Belgians are
Dutch
very
is not
patriotic.
Belgium. There's a difference.
No, that's the Netherlands, Tom.
Thank you.
Yeah. Okay, let's move on quickly. Mark, we need you to save us in just a moment. Equity futures right now on the S&P softer by not even 0.1%. We're pulling back over the last couple of days, though. Yesterday on the S&P 500, incidentally, biggest one-day loss on the S&P.
Cratered.
Going back to late May. In the bond market, we talked about these levels. 2-year, 5%. 10-year, 4%. Yields up again this morning by a couple of basis points. Call it up 3 to 4.0576% on a 10-year. And the euro just short of 109 at the moment, 108.91. Lucky to have Mark Cabana of Bank of America, the head of US rate strategy, with us around the table to make us all sound smarter. Mark, wonderful to see you.
Thanks for having me.
I want to start with a quote from you about the extreme inversion in the yield curve. You think this is not about a hard growth landing. You think it's about a hard inflation landing. Can you talk to me about how you identify that distinction in the bond market right now?
Sure. Yeah, our team has been doing great work along these lines. And what we really look at are what inflation expectations are priced to do, and then what real interest rates are expected to do. And what we see is that real interest rates look very, very high at the front end, and that's due to the fact that inflation is expected to decline so rapidly. Look, 2-year break-evens are just a tad over 2%, which is really amazing given how sticky inflation has been. And so when we look at that data, we just think that, well, the reason that the market has been pricing rate cuts from the Fed is because inflation is expected to fall so quickly. Meanwhile, real rates are very elevated. And what we've been recommending is that if investors are worried about a harder economic landing, you want to be long real rates at the front end. But if you're worried that inflation could be more persistent, a problem that we've seen globally, front-end inflation looks way too low to us, and that seems like a good own and a good way to position just a higher and stickier inflation.
I'm still a phrase from Peter Orszag, now holding court at Lazard. Peter codified the modern idea of glide paths. Are all these relationships, these curves, these time series, are they smooth, orderly glide paths, or do you worry about instability, kinks in the curve, or jump condition?
I think you have to worry about those types of jump conditions because when you see such persistence in inflation, when you see such resilience in the economy, you're only in one mode if you're a central banker, which is that, well, we haven't done enough, policy is insufficiently restrictive, we need to do more. And then what that typically leads to is an overshoot. We certainly have seen that with some signs of regional bank stress. We do worry that you could see credit conditions tighten more meaningfully in these types of dynamics as well. And I think you have to worry that you might be too restrictive for too long.
My history of this, whether it's Meltzer or Bernanke, frankly, is overshoots always happen because they're mortal. They just keep going. What's the x-axis look like of an overshoot? Can an overshoot be mollified out one Fed meeting? Is it out 2 quarters? Is an overshoot a 6-month process?
Well, I think that what the Fed is doing is recognizing that they may indeed run the risk of overshooting, and so it makes sense to go slower. And that's one of the reasons why we think the bond market has been effective at taking out some of the cuts that have been expected in late 23 and the first half of 24, because the data clearly suggests that the Fed needs to continue to tighten. They have every reason in the world to keep going. The payroll report we're going to see in a little while will likely give them further justification to keep tightening. But the fact that they appear to be going slower does seem to be taken in the context of not wanting to overshoot. And if you're a Fed that doesn't hike too far too fast, it runs the risk of you reducing that overshoot. And it also perhaps means that you won't have to take back some of the tightening as quickly.
How much weight should we be putting on labour market data as a policymaker making these kind of decisions?
Well, again, the Fed has two key inputs, right? Labor and inflation. And when you see that the labor market is still so out of balance, you've got to take that into consideration. And you know that you're not going to have a good chance of achieving sustainably lower inflation unless the labor market is indeed in better balance. So they've got to take it very seriously, and that's certainly going to be a tailwind that keeps them in hiking mode for a while.
When they say better balance, do they mean higher unemployment?
Yeah, to some extent. I mean, they think that the unemployment rate in the longer run will be around 4%. They know that they're going to need to see either outright job losses or much slower job gains. Powell has told us in the past that about 100,000 NFP per month is his bogey, more or less. And so they really do need to see further declines or further deceleration in the job market in order to convince them that they've got a shot of achieving 2% inflation.
Ellen Zentner and Morgan Stanley joining us later. Sarah House of Wells Fargo with us in the previous hour, talking about the prospect of labour hoarding, corporate America holding on to workers, and some of them pointing out that maybe we should be focused on things like the average working week, reduced hours, just evidence of corporations not letting people off but reducing their hours. Is that a dynamic that you and the team at B of A with Mike Gapin, you guys are focused on too?
Absolutely. And one of the things that Mike and team have been talking about is how we've seen a decrease in breadth of the hiring that has been taking place. We're seeing more hiring in what they've referred to as high-touch services, i.e. leisure and hospitality, education, healthcare, the types of work that's more difficult to do remotely. That's where the labor growth really appears to be concentrated. We saw that in ADP yesterday as well. And that really does show that the breadth of hiring has narrowed to some extent. You're no longer adding as many jobs in manufacturing or financial services or elsewhere. And we do think that that is somewhat consistent with labor hoarding, or at least some softening in the labor market, consistent with declines in average hourly, or with declines in the average work week.
Liz and Saunders of Charles Schwab just put out on Twitter a brilliant scatter dot chart. All you got to know, folks, a scatter dot chart looks like, say, shotgun pellets in a piece of paper, and it shows how this year is so out of the norm. It is absolutely bizarre, whatever the relationship of her chart is with real inflation and that. The bottom line is we're living in out of norm space. If we're out of norm, should we be investing normally? How do you take the cabana world and bring it over to, okay, this is what you ought to do?
Yeah, well, so as far as interest rates go, which is our wheelhouse, what we've been recommending to clients is that, look, you've got to stay underweight the front end because the Fed is going to continue to tighten. They are not done yet. But at the same time, you need to be mindful of the fact that it's a bit of an unusual world. We're not exactly sure when exactly the economy is going to peak, and you don't want to miss it. And so as a result of that, you want to be neutral the back end, if not slightly long. That means a flatter curve. And we also believe that if you're going to be long, you want to be long real rates because you want to be expecting that inflation will be more persistent over time and that the Fed may end up accepting a slightly higher level of inflation.
This is really important then. The 10-year real rate is what an amateur like me looks at. I learned that from watching The Real Yield with John Farrow every afternoon. Now,
Not anymore.
The Real Yield with Katie Greifeld.
Watch that instead.
I'm in the surveillance snap usually. I watch it on tape, on digital. But the bottom line is the 10-year inflation-adjusted measurement has gone from 1.5-ish to 1.8-ish. Where's the cabana normal on that key data point?
Yeah, we think it looks high. We think that that's
you think it's high now?
Yes.
Oh,
we think that's a good own if you are a longer-term investor. We don't expect that will sustain itself.
It will not go back to
over the longer run.
2006, 2.05%, 2%, whatever.
Look, in the near term, you really need to see some type of positioning adjustment or some type of softening in the data to stop rates from rising. And I can't guarantee that the 10-year won't retest 2% real in the very near term. But generally speaking, we think that 10-year real rates at around 1.8% are quite high historically, and we do not expect that they will persist in the longer run. We think that they're a good own for investors.
Final question.
Good
Why don't they
means
dissent
buy it.
at the Federal Reserve? Why don't they dissent over on the FOMC when clearly they wanted to? You can see it in minutes. What's that about?
Yeah, you know, I guess that they like to be a part of a consensus-driven organization. It seems like
Is there value in that, Mark?
Look, I think that you need to be comfortable speaking out if you really do disagree. It seems like they've been more comfortable to do that in their subsequent speeches as opposed to doing it when they actually sit around a table. I do think that we are getting to a point in the economic cycle, though, where data has become more divergent, opinions differ, and it certainly wouldn't surprise me if we do see more dissents build over time.
Mark Urbana, I've loved it. Thank you, mate. Thanks for being with us. Mark Urbana there of Bank of America on rate strategy, Federal Reserve, and some of the economic data we get out a little bit later this morning. If you are just tuning into the programme, welcome to the programme. The S&P 500 right now. Equity futures negative by 0.04%. Coming up very shortly, we'll catch up with Chris Morangi of Gabelli Funds. Looking forward to that. We'll also be speaking to Randy Krosner, the former Fed governor, Tom, a little bit later in the next hour, going into the payrolls report shortly.
And this is about the theory that's underlying. I'm going to go to Sintra with him, and that it's Sintra. What I saw were 4 central bankers without a theory. The Bank of Japan guy Ueda was wonderfully articulate as a new member of the chosen 4 major central bankers. But is there an operative theory out there, or is it like Liz Ann Saunders' glorious scattershot, where we're living a completely outlier 2023?
I'll go back to what Seth Carpenter over at Morgan Stanley discussed, who was there. His reflections on Sintra, just the absence of conversations about financial stability.
Yeah.
When those conversations were so dominant, that debate was just a couple of months ago. And now all of a sudden it's back to where we were pre-SVB. Inflation's too high. These central banks have got to do more. Are we taking our eye off the ball just a little bit again?
I'm reading every article on commercial real estate. I'm not being gloomy about it. I don't want to be doom and gloom, but I just think it's part of it that we don't watch. Yeah, it's got a New York City bias to it. That's my own problem. But nationwide, to monitor commercial real estate, I think, is critical right now.
Number one takeaway?
Part of that.
What is it?
They're coming down. It's irreversible. The cycle, it's not like a 30-year mortgage. The cycle in commercial real estate as an amateur, I'm going to say, is 7 years. So it's like England. It's more acute.
Can I just say that 30-year mortgage at 2-3%?
Every day.
Oh, take
Mark,
me back in time.
Help me with this. Every day, Ferro brings us.
Take me back in time.
He's looking in the 60s and 70s.
I want to go back a few years. I want to go to a First Republic branch and just say, give me all your money, but in a nice way, not in a bank robbery kind of way.
That. You're a hitter. I mean, you're on threads.
I'll give you 2-3% over 30 years. Give me all your money. Can you imagine? What a trade.
Yeah.
I remain concerned about whether inflation will return to target in a sustainable and timely way. And I think more restrictive monetary policy will be needed to achieve the FOMC's goals of stable prices and maximum employment.
Laurie Logan there of the Dallas Fed, the president at the Dallas Fed, ready to go again. And maybe again, and who knows, maybe again after that. Going into the payrolls report, which is just coming up shortly, just around the corner later this morning, 1 hour and 13 minutes away. We're looking for 230,000, Tom, according to our Bloomberg survey.
This is one of the benefits here, folks. We do no planning here. John and I have absolutely no clue what's going to happen on the show. We really delegate it out to Amy and the team, as best they can. Qantas is in meetings all day, but other than Qantas, the team is putting it together. And Laurie Logan, she comes up to me at Jackson Hole. How you doing? She's newly appointed, Dallas Fed. And I think for our audience into this jobs day, we don't talk enough about how different each region is and how different each governor is. And there's a culture that Laurie Logan represents in that statement about higher rates. We got to toe the line, versus what we hear from other Fed governors and presidents. It's hugely American, hugely cultural.
She's clearly on the hawkish side of the spectrum right now, looking for tighter monetary policy. Certainly, that speech took on greater importance after the blowout jobs report we got yesterday from ADP. And those comments came shortly after that jobs report. ADP was just a blowout, Tom. I think a lot of people are willing to put that to one side and say...
Yeah, really? You think so?
500K? Yeah, sure. I mean, look at how the bond market
500K,
responded.
but they're still going up.
No, absolutely. We're on the same page. We've had a stream of upside surprises in US economic data over the last few weeks, which suggests this Fed does indeed need to do more. There are some people, though, Tom, that take a different view on this, that think that this data and these beats we've seen just reintroduce the risk of the Fed going too far.
And Citigroup with a low number today. I mean, I'm going to call them an outlier number. As we saw earlier, 170,000. The whisper number, we went through this last hour. Let's do it again. We'll do it in the 8 o'clock hour before that 8:30 report. McKee to the rescue, the terminal. For those of you with the Bloomberg terminal, this is one of the reasons why you have a Bloomberg terminal is weird stuff like this. We have a whisper number.
The whisper number's getting higher. It's been surging.
Bring it up if you can from 260. That's a ginormous number. I mean, that's nowhere near where Chairman Powell wants it.
No. And this is why it's taking so long for the economy to slow down. Torsten Slock, Apollo, put out a great piece moments ago. I'll share some snippets of it with you. He's put out 5 points. Here's 3. High savings in the household sector. Post-COVID, strong demand for air travel, hotels, restaurants. During the pandemic, high-yield IG corporates extended the maturity of their loans, making them less vulnerable to higher interest rates. Point number 3, and we discussed this 20 minutes ago, US households have 30-year fixed mortgages and are therefore less sensitive to Fed hikes. Higher mortgage rates for home buyers are holding back supply of homes. Just a couple of points there as to why it's taken so long to slow this economy down.
We'll get Torsten on soon. It'll be good. Right now, we're going to digress here. Christopher Morangi joins us. He's co-CIO with Mario Gabelli at Gabelli Funds. I'm going to do an audible here, folks, because I know it's front and center for my colleague Paul Sweeney. Look for us 9 o'clock on radio. We do not have Mohammed El-Arian with us today. Hey, Chris, I'm going to go to the heart of Mario Gabelli's work, which long ago was the media companies. You're expert at this. For our viewers and listeners, we know, we can feel at home the industry's in total chaos. Can the media business, as a generalization, can it find a new profitability?
Morning, Tom. Yeah, well, the short answer is yes. This is a business in transition. It's been in transition for many years. It's not the first time it's gone through transition. Obviously, you've had the move from radio to TV, from broadcast to cable, and now we're going to direct to consumer. And changes in profit pools. On top of that, you've got cyclical headwinds as well. Trying to connect this to Jobs Day. And the cyclical has not been good. Advertising's been in a recession for over a year now. Early indications from this year's upfront ad sales are not looking great. Companies are pulling back on some of their marketing spend. So that's an additional issue on top of all the secular changes that have gone on.
I mean, on a people basis, I've got Iger at Disney looking for an extension of his contract out to 90 years old, whatever the gentleman from Ithaca College is going to do. And then I got Zaslav over at Warner Brothers Discovery with a value high debt load proposition. Do you want to go with a blue chip outcome like Disney, or do you want to go with a troubled merger story like Warner Brothers Discovery?
Well, there's a tremendous amount of upside in Warner Brothers. And I would note that one of the attractions there is that 90% of their debt is actually fixed. So you got to look a little deeper. They are highly levered. They're knocking down that debt pretty quickly, but they have locked in pretty attractive interest rates. And I think they're realistic about their prospects. They're beginning to sell content to third parties or resuming selling content to third parties. They don't need to stream it all on their Max app. So I think Zaz has a good vision. It's been difficult to implement. There'll be more bumps in the road. But again, tremendous upside there versus a $12 stock.
One final question on media. Do you overweight it, or is it a normal part of a Gabelli portfolio?
Well, at the moment, we've de-emphasized the sector a bit as we go through this transition. There, frankly, aren't a lot of media companies to buy, and we'll see, I think, consolidation as this goes on. So there, at some point, maybe under a different FTC, going to be a lot of opportunities in the space.
Chris, what kind of media company do you want to own? Is it a pure media play, pure streaming play? Is it something like the Walt Disney Company with the theme parks attached to it as well? What is it you want to own?
Well, certainly one of the bright spots in media, and one that we have favored for many years before COVID, has been this entertainment, live entertainment and sports concept. There are pretty well-known secular trends, Gen Z, millennials, investing in experiences versus things. And we express that with our ownership of Liberty Braves, which is the public company that owns the Atlanta Braves Baseball Club. Sorry, Tom, as well as MSGS, which owns the Knicks and the Rangers. You go to any of these events, they're packed, people are watching, and they will hold their value no matter what the media backdrop might be.
Chris, it's amazing to see what's been happening with services in America. We know how busy the airports have been over the July 4th holiday. Chris, it's not just the airlines. it's the cruise operators as well. From your perspective, and I guess it's a question that applies to the world of economics, Chris, but for your perspective, how long is this going to last? This pent-up demand from the pandemic that's being splurged right now on vacations.
Yeah, well, I think there's been a lot of concern that it won't last, which is weighed on the parks of Walt Disney and Comcast as well. But, again, this existed prior to COVID, and COVID just added fuel to that fire, fuel to the desire to get out. There really is a true predisposition to spend on these experiences. I don't think that's going to change. There's a lack of supply, right. And that's benefits the owners.
Chris, one of the hallmarks of Mario Gabelli and what, frankly, Mario Gabelli invented was a value that's growthy. Right now, how do you define growth within a more measured, conservative value proposition?
Yeah, we don't really agree with the index keepers' definitions of growth versus value. Growth is a component of value. It can add or subtract from value depending on the cost of capital and the moats around it. So, we don't mind. We, in fact, love buying growing companies as long as they are trading at a discount to their intrinsic or private market value. So, we have avoided some traditional, quote unquote, value sectors like banks, we still do, and energy, both of which because they're commoditized industries.
Chris Marangi of Gabelli Funds. Chris, love to catch up. Thank you, sir. On a Payrolls Friday, talking about the media companies, services, TK, and other sectors too. The demand, the pent-up demand for services in this country has just been phenomenal to witness over the last couple of years.
I don't think anybody saw, even the people that were pro-services, pro-airlines,
that's amazing.
And all that, I don't think they saw it coming.
Cruise operators.
Why is Gabelli different? Gabelli's different because they started as sell-side securities analysts. These are people chiseled. You see Marangi, you don't see this on radio, but over Chris Marangi's left shoulder there were 200, manila envelopes, manila folders rather. Right. Each of those is a company. That's old school. Marangi's old school. That's what happens when you go to Williams. You don't do the computer stuff. You don't do Bloomberg Intelligence. You got a manila folder with stuff in it telling you about your company, and you go and you reach for your company, and it reaffirms what you want. It's old school, Gabelli.
You're reminiscent.
Yeah, it's old school.
Good times.
Yeah, before PDFs, before computers.
10-year, 4%.
Back with a quill.
2-year at about 5%.
Dip the ink in.
Payrolls an hour away. We're just going to keep talking over each other.
Yeah.
Okay.
It's the shtick.
Ellen Zettner and Morgan Stanley. That's the shtick. Ellen's up next. Absolute nightmare. Nightmare. We're talking about White Lotus in the commercial break. Can you imagine TK as a hotel guest on vacation? You'd be a nightmare. You would just be, I cannot, I've been in bars with you and your trouble.
I was thrown out of the Hassler in Rome once.
I can believe that. What, because you don't like how the martini was made?
They rolled me down the Spanish Steps right into the fountain.
I can believe that.
Yeah.
Ellen Zettner and Morgan Stanley coming up shortly. Don't miss this conversation. Just going into that, I want to give you a snapshot of the price action at the moment. The equity market's shaping up as follows. On the S&P futures, just a little bit softer. We're negative here by 0.1%. A couple of days of losses on the S&P 500. Yesterday, incidentally, the biggest one-day loss going back to late May. On the Nasdaq right now, we're negative 0.2%. Softer across the board because of this right here, the bond market. Slice and dice the yield curve, 2-year, 10-year, 30-year, 2-year. Looking at 5%, 10-year, looking at 4%. Yields surging off the back of the ADP report yesterday. Blowout number, just to see that close to 500K. It's a head scratcher, isn't it, Tom? You come into a number like that and everyone says the same thing. ADP, don't really care. And then you see 500, chaos. Yields on a 10-year, 4%. I think we closed at 4% yesterday for the first time since the collapse of SVB. And it's been remarkable to me, to you, Tom, to others as well, how quickly we've moved on from the SVB malaise. We stopped talking about it. We're now focused on the Federal Reserve hiking again. And yields are back at levels where they were almost 7 or 8 basis points below now, through them yesterday at the front end, where they were right before the bank started to collapse.
Rounded up 5.01% on the 2-year yield. We could do data checks all day in fixed income, and I'm going to be blunt. I am a believer that fixed income is always out front of equities. It was wonderful to have Ellen Zettner with us a few days ago, really to give us perspective here into July. And as always on Jobs Day, the chief economist from Morgan Stanley joins us this morning. I mean, 270,000 is a big number. I mean,
It
there's
is.
no other way to put it.
270,000 over at Morgan Stanley. You've got Citi, Andrew Honhorst looking for something close to, I think, 170, wasn't it?
Yeah.
Tom, 170,000 over there. All of that going into the payrolls report. They're looking for an unemployment rate of 3.6%. This is what Ellen and the team has got to say. Net new job gains have come in stronger than expected over the past couple of months, but we look for a deceleration to restart as labour market indicators have shown signs of easing and the effects of seasonal factors, Tom, normalise. Less seasonal fluctuation in hiring should be a drag on June job numbers.
That's the minutia. That's what she's famous for. Ellen Zentner joins us right now on the granularity beneath this jobs report. What's a seasonal job? Are you like, is Morgan Stanley counting lifeguards?
No, we're not counting lifeguards, but there are. Look, these months around June, July are difficult and volatile months in jobs data because
June is harder to guess than most months.
Yeah, because you've got uncertain and changing times of when kids are out of school.
Yeah.
You can see it in the jobless claims numbers too. Some fluctuations there around the timing of summer things. When did kids get out and go get jobs? When are teachers out of school? And that sort of thing. So you've always got that uncertainty. I think, John, as you said, that yesterday was a blowout ADP number.
That's nuts.
So even though, we are near the top of Bloomberg forecasters at 270, well above consensus, I think you would have to get a 350 print here to really surprise markets because they're already expecting a very big number. The markets are leading the Fed toward that July hike. Probably it would take less than 100,000 reported today for the Fed to second guess themselves, if you will, on raising rates in July.
I saw that note over the last couple of days. You set the bar for the Fed at below 100K payrolls. Was it 0.2% month on month? Is that core inflation next week?
For core CPI,
You get those two things, you don't think the Fed hikes?
Yeah, I think it raises enough doubt that the pause could be more than just one meeting. But you can see how low the bar is for them to go. And so that's why the thresholds, that's expressed in the thresholds being so low at 100K on payrolls, 0.2 on core CPI.
You can feel the committee splintering just a little bit. You can feel it. You can see it in the minutes as well. It's to be expected this far along in the hiking cycle. What camp are you in? I'm sure there's a couple of camps on the FOMC. I'm sure one is the long and variable lags crowd who believe we've done enough, it's in the pipeline, it's going to come through. Others who believe that we just haven't done enough. Which one are you in?
Yeah, so we've done the deep analysis around what could be the lags in monetary policy. We think on business investment, the greatest cumulative impact is in the fourth quarter this year for the consumption in the first quarter. But we have been writing since last year about this soft landing, and it's because the economy has much more cushion to absorb higher interest rates. To me, the complacency that's misplaced is around credit, the changes in lending conditions and credit availability, and that takes a couple of quarters to show up, which would presumably be around the third quarter. And that's something that Chair Powell talked about as well. So I'm in the camp of we're not in the clear yet, and there's a bit too much complacency out there.
We're going to rip up the script here. We do that on Jobs Day here. I'm going to look at Zentner. I can't pronounce this. Anzoy Tagu. I butchered that.
Where's this going?
Dujan Heyman. You've got a team of people over there in economics looking at, say, Jim Caron's world and the rest, looking at the bond world. What are the indicators you see in the short-term yield space that give you credit angst?
So commercial and industrial loan growth, right? It's slowed sharply. That is how small businesses fund payrolls. They buy equipment. They build inventories. It has a very good lead to job gains. And so, what did we see in the ADP yesterday? Large corporations are not hiring. We know that. Companies have been saying that. I'm hanging on to my existing workforce, but I'm not hiring. The hiring is coming from small business. That's more difficult to measure and more difficult to get a handle on when that environment changes. And they are most impacted by the changes in credit since March 8.
Ed Hyman was with us a couple days ago voicing exactly what you're saying. Ed stated with all his decades of experience, he's never been this cautious, this gloomy on the American economy. Do you share not so much the recession call and the hype over that, but just the lethargy here within the system, maybe what the IMF's talking about, just a flatness to where we're heading?
Look, I'm definitely on the optimistic side for the U.S. I think there's a great tendency to underestimate just how much cushion there still is in the economy to withstand a sharp slowdown, and that's why we're calling for a soft landing and not recession. I think the consumer is still resilient here, but I think we need to take a break. And I think what we're seeing is households outside of the top income groups have taken a break from spending. We just can't see it because those top income groups are out there with insatiable appetite for services. They're the ones going to Italy, John. I went to Greece. You know, like you can't hold me back from consuming my services and travel.
I went to Dwight Reed.
And we are holding up. We're holding up all of the consumer.
You and the team have written recently about the significance of the reduced working week, hours worked. Can you build on that a little bit for us this morning? We talked to Sarah House of Wells Fargo about it too and mentioned your work. How important is that at the moment for you?
Yeah, so hours worked is extremely important because one, it's a direct tie into GDP. It may be one reason why GDP has been running higher than GDI because GDI would pick up more of the cut in hours worked. I mean, it's picked up in GDP too, but we know there's a lot of concern out there that the GDI numbers, gross domestic income, which is running below GDP, is telling us something more about the slowdown in the economy. It's something that the minutes had mentioned as well. It also tells me that our labor hoarding story that we've been telling about companies not letting go of existing workers, and we've been telling this story for a year now, you reduce hours first before you let workers go, and that's how you control your wage bill.
Do you think labour hoarding is compatible, consistent with this idea that inflation can return to 2%?
Yeah, I do.
Can you explain that a little bit more?
I do, because you will, for a time, run payrolls, run your labor in excess of your output. Or right in line with your output, right? And so that demand for labor, it's in balance. The demand and supply is more in balance when you're labor hoarding. And so that does put further downward pressure on wages. And look, we're still stuck in the same story, and it's getting boring, it's getting old, it's getting tired. Inflation is high, but coming down. Wages are high, but coming down. Wage growth.
Right.
And so it's just frustrating. That's the frustration of the Fed, expressed in the minutes as well. Things are moving in the right direction, but gosh, we really want it to go faster.
The consumer is resilient. When I met you years ago, you were truly definitive on the pulse of the American consumer. Do you aggregate the American consumer, or is it now so partitioned because of society, technology, the issues that, say, Paul Romer, the laureate, looks at?
And it's very partitioned.
I agree. And it's more partitioned than years ago.
Yeah, and so my career started at the state of Texas studying the incidence of tax burden on Texas households. And I took that throughout my entire career. After the financial crisis, we could no longer look at households in the aggregate. We slice and dice it by income, by ethnicity, by age group, because that's the only way you can understand households today.
If I say, gentlemen, I get criticism about this. If I say that half of America's flat on their back, is that accurate?
Yeah, more than half. More than half. The top income quintile represents 40% of all consumer spending in the U.S. And their appetite right now
They're the ones in Italy or Greece.
They're the ones in Italy or Greece.
I'm at McDonald's, you're in Greece, John's in Italy. I mean, it's great.
Yeah.
We know where that quintile.
Just to be, you're at the car lot.
But that's the point, is that the concern is that when do we lose them?
Right.
We lose them when white-collar layoffs spread and rise. And that's so that we're watching that very closely.
Neil Dutta from ASOS Macro is watching this very closely. He's listening and he's got this to say. The quit rate just rose, claims are down, auto sales are up, housing is up, fiscal's a tailwind, rates are up to 4%, stocks are okay. What's that tell you? Neutral is higher. What's it tell you?
Well, it tells you that near-term neutral is higher, right? And so near-term neutral can fluctuate. The strength of the economy and inflation will tell you that near-term neutral is somewhere higher. That's where the Fed is chasing neutral now. Longer-term neutral is more structural. And that's something over the next 10, 15, 20 years.
Is our
where
start
do we
as
end
low
up?
as Williams says, or are you in a camp where our start's elevated?
I don't think structurally anything's changed about the long run neutral rates that will continue to be under pressure. I think near-term neutral, and Neil makes great points. I think near-term neutral is higher, and that's what the Fed is chasing.
Fascinating.
We're up to 42
Got to get
viewers.
Neil on. Neil's in a
great.
bit of trouble.
Yeah.
Can I tell you why Neil's in a bit of trouble?
No, I miss this.
It's Payrolls Friday.
Yeah.
He's on vacation with his wife. It's their 10-year wedding anniversary. Happy anniversary. He's logged into the Bloomberg terminal for payrolls. So can we wish Neil and the missus a very happy anniversary, TK, on behalf of the team here at Bloomberg Surveillance?
I'm going to tear up and get emotional, you know.
I think that gets you in a little bit of trouble,
Mrs.
don't
Dutta
you?
should join us on the terminal.
10-year anniversary.
We could do an interview with both.
You're logged into the Bloomberg with payrolls. We'll get Neil on the phone.
What's wrong with that? That's normal.
We'll work that out. Ellen loves this.
Normal.
It's a privilege always, every Payrolls Friday, to do this with you.
Thanks,
Thank
guys.
you. Ellen Zentner there of Morgan Stanley. TK, the jobs report, about 45 minutes away, 47 minutes away, something like that.
You know, they're all different. And this one, I can honestly say I've never seen this after the ADP. We haven't talked about it yet. But which ADP report did we see yesterday? Did we see an old-style ADP that everybody suggested was screwed up? Or is this a new one that's got some accuracy? We'll get a proof point here at 8:30.
Enough to make you nervous. That's for sure. That's
particularly
for sure.
if you're in the bond space.
Does it change July? I think a lot of people were looking for July for a hike anyway, Tom.
Yeah, well, Zentner shifted over a couple. You know, she was fly fishing somewhere, and she said, "Let's raise rates in July."
If you are just tuning into the program, welcome to the program. The S&P
would name the
500
river.
right now. On the S&P, slightly negative.
I
We're
don't know
negative
if it's
zero.
Hudson or East River. I'm not
Negative
sure.
0.08%. Coming up very shortly, the payrolls report. Neil Dutta of Renmax saying the wife loved that. He's not in trouble anymore. So, Tom, that's good news. He can stay focused on the payrolls report, and maybe he can talk about that a little bit later as well.
So much for that marriage.
8:15 Eastern time. Going into that payrolls report, we're going to hear from Randy Krosner, the former Fed governor. Looking forward to his take on things. We'll catch up with him coming out of the jobs report as well, Tom.
This is critical, and what Krosner would say and what Ellen Zentner of Morgan Stanley would say is off to the right-hand side of the equation is this thing epsilon. It's a Greek letter that looks like a baby E, and the answer is, John, nobody has a clue what that uncertainty is out there in a pandemic America. I can't say enough about the importance of the Liz Ann Saunders scatter dot chart today on real yields, and it clearly shows, John, how unusual in the lower left quadrant is 2022. This is about the pandemic, and I would suggest with respect, it's still about the pandemic.
We need to talk about the politics as well, TK. Where is this labour market going to be? Never mind year end. What about November next year, going into the election? Where's this labour market going to be? Terry Haynes of Pangaea coming up shortly.
Yeah, we had our first meeting yesterday, folks, on the political path to the first Tuesday of November. It's upon us with the Republican debates in August.
You want to talk about how that meeting went? It was just you and I shouting across the newsroom.
Could you imagine
that was
the
the
two
first
of us
meeting? Is that it?
moderating a Republican debate?
It would be entertaining.
I'd have to have extra tang for that.
I don't know if the RNC want that.
I don't think they would.
No. Terry Haynes of Pangaea Policy. He's coming up next. Futures, slightly softer. Payrolls, still ahead.
I knew we had to reclaim America's leadership. Now, all over the country, semiconductor companies are investing a record hundreds of billions of dollars to bring chip production back home. We know for too long, China's dominated the production of raw materials needed for critical products. That's why we're building alliances with our friends all across the world.
The President of the United States, industrial policy, the shifts we're witnessing right now worldwide, something we've got to track for the foreseeable future, and particularly going into the election campaigns of the next 18 months or so. If you are just tuning in, welcome to the programme. We're counting you down to the payrolls report, which comes out at 8:30 Eastern Time, about 43 minutes from now. Looking for something close to 230,000 in our survey here at Bloomberg. Going into it, the market's developing as follows. Equities a bit softer, but no drama. We're down by not even 0.1% on the S&P. Yields taking out new numbers, 4% on a 10-year, 5% on a 2-year, encouraging this idea that the Fed is set to hike again later this month and maybe again, Tom, in September too.
That's the economic data that we'll see at 8:30 here, and part of the economic data is how it will be addressed. Do you still talk to the Secretary of Labor at 9 o'clock? Are we still doing this ballet?
Well, we've got an acting Labour Secretary.
I didn't know that. We don't have a
confirmed
replacement.
Walsh replacement.
Can you talk to Walsh about National Hockey League? You know, I want the goal
We
bigger.
can work that out. We can try and get Walsh on this programme to talk about
It'd be good.
NHL.
You know, I'd like to talk to him.
Quite a trade for him, wasn't it?
I liked your interview because you didn't do it like an American where we're deferential, please, Mr. Secretary. What do you think? You were like...
Can I say, not everyone's a fan of that. Not everyone's a fan of that.
We're always deferential to Terry Haynes, founder of Pangaea, and he joins us right now, Pangaea Policy here. Terry, I am bedazzled by what I would suggest is a focus on what I'm going to call the far right, like an old fossil. And then you've got the far left, and I'm going to go to Vice President Harris and the news flow of the last 48 hours, where she's speaking to one part of the far left. Is anybody speaking to America's middle? I mean, the Spiro Agnew, whatever the vice president's name was, the silent majority on both sides of the aisle. Is anybody talking to the middle in the summer of 2023?
Well, you two are not the nattering nabobs of negativism, as Vice President Agnew liked to call the news media. Yeah, they're trying to, but they tend to get drowned out by the extremes. I always say that there aren't two political parties in Washington. There are four factions, and what you saw in the debt ceiling spending deal this spring was really kind of a triumph of the centrists, people coming together over those folks. They're trying to speak to them, but yeah, they tend to get drowned out by the bread and circuses on both ends.
Well, the bread and circuses on both ends as well. Now we're going to the first calendar John and I are looking at, which is the August debate of the Republican Party. Are they going to speak to their far right, or are they going to actually try to address anybody in the vicinity of the middle?
Well, I think they try to do both. One thing I see in the Republicans, and I saw a DeSantis quote this morning illustrating this actually, is I'm not going to try to puff up my poll numbers in June or July. I'm focused to win in January or February. That's what a lot of these folks are doing. What they're trying to do is try to fuzz things up a little bit so that they essentially keep the far right kind of quiet and understand that there's patriotism at work here from the nominee, but at the same time move towards real centrist policies and talking about what they would do going forward. And there's a real market for that. One way you can interpret what Ellen Zentner said to you in the last segment is that there's 2/3 of the public that aren't really being served by what's going on, and that's a thirsty audience that really wants to hear from new blood in the Republican Party and the Democratic Party. Frankly.
We'll hear from some of them next month in the first debate, which I believe is with Fox News. Terry, many people waiting for this field to get whittled down, to be reduced. Do you think that will be the case, and how quickly can that happen?
Yeah, I think so. Chris Christie gives a good summary of this. The idea is essentially that you get into your first couple of debates, and after that, if you don't land and you don't start expanding your voting count and your percentages, you're going to get pretty quickly starved of the money you need to continue. So yeah, I'd look for this field to be substantially whittled down before the beginning of the year. What a lot of these people are running for cabinet posts and for their own prominence in the party. And from their perspective, that's not a bad thing.
Terry, a lot of people have already written off Governor DeSantis. It's still pretty early days. And as you know, things can change after debate 1, debate 2, debate 3, whatever. Terry, your view on the governor of Florida now, where are things going?
I think being a viable and clear second place is not a bad place for him right now. I think that Trump's at very much his high water mark. And one way to look at, the way I would suggest you look at what's going on in the Republican Party right now, is you've got half or 60% of folks that already want a Trump alternative. And if they see somebody they think is viable and they think can win, whether it be Governor DeSantis or somebody else, I think those folks flock to him.
Terry Haynes, I'm absolutely fascinated what you would advise the former governor of New Jersey, Chris Christie of Newark, a former catcher in baseball. He's now a little bit bigger, I think, to be the backstop on a wild pitch. But what would be your advice to Chris Christie to gain momentum?
Well, I think really two things. One is that I think he's taking on the role of the anti-Trump and making the case very forthrightly. And I think that's something that you need to do, and I think that does help him. But I'd also build out his economic message. He's great at saying that he compromised with the Democratic legislature in New Jersey, but that's not going to cut it for a lot of Republican primary voters. What needs to happen for Governor Christie is he needs to talk a little bit more about what he'd do economically and how he'd help that half to 2/3 that don't feel helped in this economy.
Is it a penalty for him to be from New Jersey? I mean, how does he play? Forget about DeSantis, Florida, or the other more MAGA states. I mean, it's a whole new calculus, isn't it?
Oh yeah, it's by you're absolutely right that it is a detriment being from New Jersey. And, frankly, he needs to talk a lot more about his record. And I don't mean going granular, but a lot more about what he was trying to do in New Jersey, how he breached those gaps. Bipartisanship is not the end goal, but it's part of what was necessary to do what he wanted to do, and how he'd do that nationally.
Terry, just a final word on China, if you will. There's a new word buzzing around in the last 24 hours. It's not de-risk, decouple, it's diversify, from Janet Yellen, the Treasury Secretary. Terry, I wonder what you made of that, and does that set the stage for a meeting between the leaders later this year?
Well, I think that's a good one. My view of the China business, as you know, is that China's rope-a-doping the United States along, and now I think it's more likely than not they get that meeting, but it is not likely that we get anything substantive before then.
I mean, my takeaway from this interview, it's always a benefit with Terry Haynes. But the major issue here, John, is the way Haynes throws shade on New Jersey.
Quote.
I mean, can you imagine it with the New Jersey State Police on the Garden
You threw
State
shade
Parkway?
on New Jersey. You threw shade on
Terry,
New Jersey.
your
That was
words.
great for you.
It's a detriment to be from New Jersey. That was
Well, no, if you're a
precise
presidential
quote.
candidate in the Republican Party, sure.
Terry Haynes of Pangier. Terry, thanks for clarifying. Terry, appreciate it. Good to catch up, as always. This is going to ramp up later this summer, TK. It's going to come up quickly. It's already July. First debate in August.
I think everything's shifted forward 3 months. I think what we think about in February of the election year is going to happen in November and December. We've got a little bit of history now with 12 people on stage or whatever the number is. 1 cycle, 2 cycles. And the key insight there, seriously, folks, from Mr. Haynes, is it's going to get whittled out quickly. Says who? I mean, these people will hang on forever. It's like you and me. They want to get rid of us. But, we love the lights. I mean,
I'd love to hear from Team Trump on one issue. Greg Valliere raised this from AGF Investments earlier this week with us. Does the former president need to go into those debates next month? What's the value there for him?
I mean,
does he need to go? He's got a solid lead.
Given the litigation stream, the potential litigation stream, on and on and on. What's the upside for him to be in a debate right now? I don't see it. I don't see it.
Maybe that conversation picks up. It's jobs day.
It's jobs day.
Payroll's just around the corner. 230,000 the estimate. Great lineup of guests for you coming up shortly. Nadia Lovell of UBS will be joining us. Randy Krozener, the former Fed governor, we'll catch up with him a little bit later. Equity futures, stocks negative here by not even 0.1%.
These are periods where you're seeing a lot of chop in the economic data.
There's too much labor hoarding going on, not yet enough labor shedding going on.
If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
3.7% on unemployment is not going to catch the Fed's attention. 4.5% will.
We're still looking at a very tight labor market right now, but I think there's continued pressure ongoing when we look at the stance of monetary policy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. Jobs Day, Bramo. She's taking a job. She's portaging on the Racket River. She's on like 4th lake or 5th lake or 3rd lake.
Is that what she's doing?
Yeah, the deer flies, they're like a B-52 bomber at Camp Drum. The deer flies are so big the wings sag.
I got eaten alive by mosquitoes. Some of the bites.
But they're Italian mosquitoes,
Brutal.
so they're like, it's like upscale mosquitoes.
They're more fashionable.
Yeah, but
mosquitoes.
gelato, the gelato keeps them away as well. It is Jobs Day. We welcome all of you. Moments ago, to show you how unusual this is, Ian Shepherdson of Pantheon. He's been wonderful. John, payrolls are a total wild card. That from Ian Shepherdson.
Well, particularly after the report we got yesterday from ADP, which was 497,000. The estimate this morning in our survey for non-farm payrolls, 230K. The number drops in about 29 minutes' time. A lot of people on board with this idea the Fed hikes again in July.
Yes.
That number would have to be terrible to reintroduce the idea they won't. Ellen Zettner said it would have to be sub 100K plus. You'd have to get a soft read on CPI next week.
And the answer is 170 doesn't do it. Citigroup just republishes before the report. And I like this, John. Discuss it. You're more up to speed on what they're doing than I am. A lack of loosening is not evident, is from Allen Orst.
And that's not compatible with return to 2% inflation. That's Citi's view. For me, Tom, and for this note from Andrew this morning, I think this is important. This is less about July. It's less about September even. It's about setting the stage for policy beyond then. when the chairman has to go to Jackson Hole and potentially deliver another address. Now, Andrew said this morning. The risks are rising that the Fed will once again need to deliver a more hawkish message, perhaps at Jackson Hole in late August and or in September at the FOMC meeting. Now, that's a completely different game away from the will they, won't they hike in July.
And dare I say, it gets us to the drama of November. November 1 is the meeting after September 20. But this lack of loosening, within the continuum of all the data we're going to see here in 27 minutes, John, a lack of loosening is the heart of the matter, however you want to look at that, whichever data you want to look at. It's not happening.
Well, let's pick a single data point, 3.6% unemployment. That's the estimate today, down from 3.7. The Fed before had unemployment year-end at 4.5%. That projection has come down to, where are we now, 4.10 for the end of 2023. They've had to completely change their view on where unemployment's going to be year-end, based on how resilient this labour market has been at the top line, the headline numbers that we've seen recently.
And to what Zentner said socially, and this goes to the interview with the acting Secretary of Labor today, and the basic idea here, John, is a partition in America. We can talk all we want about business class, name the airline, forget about it. Ellen Zentner of Morgan Stanley made very clear more than half of America, as a general statement, is flat on their back.
People are struggling. We know that. If you're a debtor right now, Tom, you don't have the cash to park at the front end of the yield curve and pick up 5%. That means nothing to you. That means nothing to you at all. You know that. There are two different worlds right now with 5% interest rates. It's affecting people very differently.
Well,
not just in the US, but elsewhere too.
Let me get this up right now. I can do this. USGG. Some of us memorize the functions on the Bloomberg terminal. John is better at it than I am. We have a whole speed index that really revolutionized things. Moments ago, John, we had a 30-year bond leap, I say leap, above 4%. That happened yesterday midday, and it's come back again right now. The benchmark 30-year bond, long ago, John, the benchmark, back when the Dow Jones Industrial Average mattered.
Still matters.
30-year yield mattered. 30-year yield, 4.01%. First thing I looked at today was a new high on a 30-year mortgage.
Well, the first thing I've looked at over the last couple of mornings is not just the front end of the US curve, it's the front end of the UK curve. So I'll raise you GUKG2 on the Bloomberg terminal to get the front end of the gilt curve up. The 2 years, just remarkable, Tom. We're looking at 550. And bank rate, there's a conversation through this week that bank rate at the Bank of England could go through 6 over the next 9 months.
And this is not a Vin Scully remarkable, the great Dodger voice, and the way he used remarkable. John, I take the point of a number of people. I'd really, when you speak to Dr. Alarian today in the 9 o'clock hour, I think this will be really interesting. To me, it's almost a panic move. It's got a what we call stochastic character to it. It's not like a lift, which is what we're seeing in the U.S. It's a spike up.
I'm pleased you brought up Mohammed, because he's written a new column, and it's about the over-reliance, over-dependence on monetary policy to address the demand side of this inflation equation, and not a big enough willingness to be open to doing something, Tom, more structurally on the supply side. And that's going to be something we have to talk about a little bit more, and we'll do that as well in about an hour's time.
It's going to be interesting to see. On the data front, I'm looking at disinversion, 105 beeps out to 95 beeps, less of an inverted curve. In the 10-year real yield, I'm sorry, it matters, 1.80%. I thought Mark Cabana of Bank of America was brilliant this morning.
He was great. Couple of days of losses on the S&P 500. Will it become 3? The fate of the session, I guess, dictated to some extent, to a greater extent, by the payrolls report, which drops in about 24 minutes. Equity futures, stocks softer on the S&P, down by 0.1% on the S&P 500. And you see it there, Tom, again, nominal yields higher by 3 basis points, 10-year, through 4%, comfortably so now, 4.06% on a 10-year.
We start strong in this jobs report half hour with Nadia Lovell, senior U.S. equity strategist at UBS Global Wealth Management. It's an econobabble half hour. Let's bring it right over to equities. The pullback that we've seen recently, is it the end of this surprise bull market, or can you own equities through this jobs report into Q4 of this year?
Look, I think that you can own equities, but I think you have to be selective in equities. Tom, you've been making a great point around real yields, and we have seen the market fly in the face of higher bond yields so far this year and stretching valuation and really lowering the equity risk premium. But this past week, the economic data that we've got, we're starting to get a gut check, and it's really causing the market to reprice growth and what it means for the path of monetary policy. Of course, a stronger economic environment can mean that we can see a faster recovery in the earnings, but what are you paying for those earnings? That valuation is still too high.
You beautifully frame it. That's where I am and where I've been for the last couple days. If we get the kind of economy that seems to be dealt with this right now, does that sustain nominal GDP, top-line GDP, and does that sustain revenues where everyone's going to get wrong once again the earnings call, the earnings gloom?
The earnings have been coming in better than expected, but they're still negative, Tom, in the first quarter. In the second quarter, the consensus is looking for a 7% contraction. We do expect that to come in better than where the consensus is, just given how strong the economic environment has been. But when you look in the back half of the year, we do expect the economy to slow down, and we also are expecting inflation to improve. Quite frankly, we're looking for core CPI to trend towards 3.5% by the time we get to the end of the year. And so that inflection that you're seeing in earnings in the consensus number, the 8% growth that they're looking for in the fourth quarter, we just don't think that that's likely. So we think that there's going to be a little bit more trimming come to the back half of the year earnings outlook. But for Q2, we do think that earnings will likely beat, but you're not going to see the same follow through in terms of the price reaction as you've seen in the first half of the year.
Nadia, let's say you're right. Where would you expect resilience to be within the equity market beneath the index?
We think that, in our preferred sectors, we recently actually upgraded the energy sector in the last couple of weeks because we do think a bearish outlook is overly priced in that sector. Oil prices have struggled year to date, just given to supply that's come into the market stronger than expected, particularly from Russia. But you are starting to see the impact of the production cuts from OPEC Plus. We're already seeing crude export at a one-year low, and that's likely going to go lower, particularly as Saudi Arabia and Russia implements additional cuts. So we think that there are some opportunities there within energy. The energy companies are still very strong balance sheet, strong free cash flow and dividend yields. Within energy, we like the oil services companies as well as E&P and some of the integrated. So the numbers have come in, we think, far enough now for energy, and that could be a good setup in the back half of the year.
Nadia, that's going to be a little bit hard to digest for some people, that you're looking for this downturn and bad earnings and ultimately an economy that won't do so well, but you still like opportunities in energy. How does that add up?
Yeah, it's really the global economy as well. And even though you might see some slower economic growth in the U.S., overall, oil demand still remains quite high. And we think that this imbalance that you're seeing in the market is going to correct itself, and we're looking for a deficit in the second half of the year. So some of it is the supply coming down to be able to have the market in deficit in the second half of the year. So it's a bit of a more of a contrarian call. But again, we think that the energy sector is already priced in a recessionary environment, and we're not calling for a recession in the second half of the year. We're calling for more subdued growth.
Is the UBS view persistent free cash flow? This phrase, I detest this, Nadia. We need to buy quality. What's quality right now?
Quality of those companies that have absolutely good free cash flow generation, more resilient earnings, and also just overall stronger balance sheet. So even in tech, I would say, Tom, even though we have a least preferred preference on tech, we're not necessarily saying to go out and sell all your tech companies. We're saying to focus on the more quality companies, the defensive areas of tech, and rotating out of the more cyclical, highly cyclical areas of tech. So overall, is looking for good free cash flow generation, also a bit of a return to capital as well, defines what we think as being quality companies.
Nadia, just identify the key distinction there. Just to finish there, I think this is important. Defensive and cyclical tech. What's cyclical? What's defensive?
So within tech, the more highly cyclical areas are the semiconductors the sector industry. It's outperformed year to date, and so what we've been advising clients to do is lock in some profits there and rotate it in the more defensive, the laggers, the mid-cycle plays. So software companies. Obviously, we've had an AI frenzy, and we do like AI longer term, Jonathan, but we want to be a lot more selective at this point. We still see some opportunities, some good risk reward within the network areas, the memory areas of AI as well.
Can you see in August Nadia Lovell popping off 85 pages on AI?
I can, yeah.
You know, she's going to go in the office and she's going to be like, I'm taking the last 4 weeks
Why do they make
off.
them do that? Why do they make them do
To punish Nadia. You know, there's some grizzled guy on a phone in the Hamptons
Some poor
calling
analyst
into
somewhere.
Nadia who's killing herself. Nadia, by Labor Day, we need 85 pages on AI. Do something. That's how it works. That's the real world.
And then how many people read it?
But Tom,
no, they
by
read the first
Labor
three.
Day, by Labor Day, a generative AI might be able to produce that for you.
Nadia, thank you. Nadia Lovell of UBS. I once did a little conference on this with the research team over at SocGen in Paris.
Yeah.
Maybe 9-10 years ago. I remember the conversation, and there was this guy there who said he wrote this long PDF. Wasn't affiliated with SocGen, just a little committee, a conversation about how to improve the Southside research. And he said that he'd done this long PDF, and at the back he'd put a note to see if anyone would actually get to the end and read it. No one ever wrote it. No one had read it.
When I lecture on this, they say, how do you read a research report? And I say, if it's 4 pages, read the first page, find one paragraph inside. If it's 12 pages, 1-2 pages, etc.
If you are just joining the programme, welcome to the programme. Equity futures this morning, negative by 0.1%. Coming up in about 17 minutes' time, the payrolls report. And going into that, we're going to catch up with the former Fed Governor, Randy Kroesner. Mike McKee just walked into the studio, so you know it's game time. You know it gets important, Tom, when McKee steps in and gets ready to go.
Straps on the CCM tax and he comes in.
You know it's summer. I tell you what, McKee, after Memorial Day weekend, bang, white pants. Every single time.
You and I are sitting here doing the boring false
Every
suit
single
thing.
time.
It is. It's true.
Well, this is like the year-round
I like what
suit, right?
I like what Ian Shepherdson said. Nobody has a clue. I mean, I'm paraphrasing. nobody has a clue at 8:30, folks. Stay with us. It's a mystery.
Isn't that like the worst-kept secret on Wall Street that no one has a clue going
Nobody
to
has a
payrolls
clue.
every Friday?
You know, you got to be here at 8:30. McKee's going to tell you how the rest of the day's going to go.
McKee, Lindsay Piegza, Randy Kroesner, all coming up in the next 20 minutes. From New York, the payrolls report just around the corner.
If you just step back and you look at this labor market data in particular, we've surprised month after month to the upside. We continue to see these jobs numbers coming in stronger. If the Fed is looking to loosen the labor market, we're just really not seeing that in the data.
The View from Citi, Andrew Hollenhorst there, looking for a hike this month, looking for a hike again in September. The data, 14 minutes away. The payrolls report coming up very shortly. Going into it, equity futures, stocks a bit softer. Not in a big way, no drama here. We're negative 0.1% on the S&P. Yields have been moving dramatically higher. I have to say that. Following ADP yesterday, they were surging at one point for the first few hours. Yields up through 4% on a 10-year, at 4.06% on a 2-year this morning, up 3%, up 3 basis points rather, through 5% on a 2-year, Tom. Quite a development in the last couple of weeks.
Huge development, and again, it's a shifted data screen. If you look at the Bloomberg Launchpad, which is a fancy gizmo, we have equities, bonds, currencies, commodities. You can program it any way you want. John, it's just simply a changed screen. There's no other way to put it, with a 10-year inflation-adjusted yield stuck now up 3 beeps, 1.80%.
Well, we certainly turned the volume up on the jobs report yesterday, didn't we?
Yeah.
Following that data, just blowout numbers that we're still trying to get our head around from ADP.
Right. Uncertainty is in order, and that is a good place to start with Randall Kroesner. Randy, the Bloomberg interns have invaded the building. I was speaking to a whip-smart intern yesterday, newly minted after reading Kroesner out of Babson College, the pride of Wellesley, Massachusetts. And that intern, he said, "What should I read?" And I said, "You've got to read Peter Bernstein. It's required at Chicago, on risk and uncertainty." Tell me right now how uncertain you are about the American economy, the American labor economy, this jobs report post-pandemic.
I think the uncertainty is pretty high because, you know, as you guys were discussing before, it seems like the labor market should have started to slow down a bit, but we haven't seen much evidence of that. Certainly the ADP numbers yesterday and other data suggest that the labor market's still pretty hot. You know, there are long and variable lags, as my, great predecessor at University of Chicago, Milton Friedman, had talked about. But man, these are really getting to be very long on lags. You think you start to see something by now. And that's the uncertainty. How high is the Fed going to have to go? Because the Fed's not going to quit until the labor market
If the Fed, and the mystery is how high do they have to go, are these normal meetings forward, or do the PhDs, the people that worship your financial economics, do they have to amend every discussion as they get out to November 1 meeting?
Well, I think what they've got to do is try to see, are there some structural changes in the economy? And I think there have been at least some changes, whether they're permanent structural or not so sure about. Probably something structural for the labor market. We certainly see lower labor force participation. A lot of older workers have said, there's no way I'm going back into the labor market. I don't care that wages are high. I know too many people who didn't make it through COVID. I want to see my kids, my grandkids. We also have seen with the very low interest rates during the pandemic and just coming out of it, that everybody refinanced. So normally you have the transmission mechanism of monetary policy having an impact on interest rates and so having an impact on people's payments of houses, et cetera. But so many people refinance into very low fixed 30-year mortgages. It doesn't matter as much to the economy that interest rates are going up, because people's income is not being affected by that, or at least a smaller fraction of people's income is affected by that than normal.
So, Randy, with that in mind, what's the appropriate role of the Federal Reserve with that as your backdrop? Is it to just keep pushing or acknowledge everything you just acknowledged?
Well, it might mean that they need to go further than in the past. Now, I don't think they're going to have to go as far as in the late 70s, early 1980s, because they're fortunate that they started before inflation expectations got out of control, because that's what happened back then. Inflation was in the low double digits, and they had to bring interest rates to 15-20% because the Fed had lost credibility. Inflation expectations went up, but really not that much. So that's a positive. But it may mean that they need to do more work in raising rates to get the same impact on the economy of sort of taking some of the heat, particularly out of the wage demands.
So, Randy, this debate often comes down to one or two hikes. Now, 25, 50 basis points is nothing. What kind of numbers are you thinking about?
Well, I think we'll see what the data say about the labor market. Maybe the labor market's about to crack.
Sure.
Certainly the data don't suggest it, but if it doesn't, they're going to keep at it. And, I think they're going to end the year closer to 6 than they will to 5.
Okay, Randy, this is great. We're going to get a jobs report. We're going to talk about all the econobabble and that, but I want to bring it over to finance. I want to bring it over to what you actually teach at the Booth School. Can you tell the students at Booth entering last week of August, whenever it is they get through their 8-week orientation, can you tell them that we've reached financial stability?
We're not sure. So it gets back to the uncertainty that you had talked about before. Because obviously with the very rapid increase in interest rates, we've had an impact on banks like Silicon Valley Bank.
Yeah.
They thought they were geniuses by buying long-dated securities. That was fine until interest rates went up so much that the value of those securities plummeted. And you've got some other institutions that also have a lot of effectively long-term fixed-rate things on their balance sheet, long-term is commercial real estate, particularly commercial real estate. That's, I think, going to be a challenge. And so we're going to see how that plays out. And I think when we start getting the next round of bank earning reports, there may be a little bit of tumult around that.
I mean, I'm not going to mince words, Professor Krasner. I look at the stress test. The stress test is a comedy. I mean, I just don't think they had any value at all. But after SVB, from where you sit, have we seen a new enhanced financial supervision? Is there something new in the religion of looking at the banks after what we saw a number of weeks ago?
I think one thing that they are now focusing on is interest rate risk. So other signatories to the so-called Basel III regulations, the capital standards that came out from the global financial crisis, virtually everybody has an important rule related to interest rates and interest rate risk. We didn't have that in the U.S. And so I think that's going to be the key thing that changes. And my hunch is that my former colleagues at the Fed and the other regulators are keenly focused on that issue now, and they weren't before.
Randy, stay close. Jobs report, 7 minutes away. We'll catch up with Randy Krosner in just a moment and get his reaction to that. Mike McKee with us around the table, logged into the Bloomberg, waiting for that data.
Waiting for the
Ready
data.
to go,
Is
Mike?
it embargoed?
Ready to
Do
go.
you know, but you can't tell us, or do you not know what's going on?
No, I don't know what's going on. They've changed the system. We all get it at the same time. Interestingly enough, I was on a little while ago with you guys, and the whisper number was 270. Now it's 280.
Really? You changed the whisper number?
Maybe I did, but Wall Street clearly leaning into the idea of a strong payrolls report. And I was mentioning earlier to you guys, Ben Emmons from New Edge out this morning with a note that says he's got a model that shows 734,000 jobs. So that would be fun.
I'm afraid to ask.
That would be fun.
Who are the people that combine the whisper number?
Well, it's anybody on Wall Street who has a Bloomberg can put in their estimate of what they think it's going to be. I'm sure we get herd mentality.
So we got a foreign exchange trader working for Mark McCormick up at TD Securities, whose expertise is dollar Mexico, and he's typing in a whisper
Bear in
number.
mind, a lot of those estimates that come in our Bloomberg survey economists, Mike, they came in days, weeks ago from many places.
Well, you know, after you get a number like ADP, that there's going to be some upward revision, and we did see that to 230 from 225. But a lot of these are not Wall Street economists who are constantly updating.
Or following ADP.
Well, it was interesting to see all the notes that came in after ADP, because some people said, oh, we got to change it, and other people said, no, we don't believe this number.
Will we believe the number that comes out in about 5 minutes' time, Mike? We had some wacky numbers. Remember, household establishment
There's a whole
survey,
debate about that.
big distinction.
Is the labor market numbers accurate, given the weirdness of the labor market?
What does that even mean? Are they accurate?
Well,
what does that mean?
The birth-death numbers, for example, it's a plug-in number that the Labor Department puts in, guessing at what the new job formation is and companies going out of business, and they don't really know, and it tends to be inaccurate around turning points.
Interesting. Mike McKee on the jobs report in about 4.5 minutes' time. Going into it, here are the scores. Equities a little bit softer, down on the week, down on the session. We're negative 0.1%. If you go to cash, you can pick up some yield. 2-year through 5%, 10-year through 4%. That development in the last 24 hours following a blowout ADP report. The estimate, 230,000 in the Bloomberg survey. The number is up next. Jobs report in America, seconds away. Here are the scores going into it. Equities a little bit softer, negative by, let's call it 0.1%. Phenomenal moves in the bond market over the last couple of weeks, including the last 24 hours. A 2-year through 5%, a 10-year through 4%. The estimate today coming into this print, 230,000. The payrolls report with Mike McKee right now. What do we got, Mike?
Well, we're waiting for the numbers to drop. 209,000. It is a lot lower than anticipated and a lot lower than it has been. 339 last month. I'm looking for the revision to that. We'll get that in just a second. But, of course, the forecast was for 230, and we had that blowout ADP number yesterday. So this is quite a surprise. Private payrolls, 149,000. That would compare with that 497,000 that ADP found, because they measure private payrolls. Manufacturing up 7. That's a change from a negative number the month before. And the unemployment rate does fall back to 3.6%, which is what had been forecast. It is a little unusual to see unemployment dropping when we are waiting for the Fed to keep raising interest rates to push it up. Average hourly earnings come in stronger than expected, a 0.4 gain for the month of June. And on a year-over-year basis, that puts it at 4.4%, which is not the direction the Fed was hoping for. That's up from 4.3% in the prior month. Here's the revisions. Last month, which was 339, now revised down to 306. So a little bit weaker for the last 2 months then. And the change in manufacturing payrolls, which was -2, is now -3. However, the average hourly earnings revised up for May to 0.4, and that put May at 4.4. So So basically, we're unchanged between June and May. Negative 110,000 total revised jobs for April and May going into June. So what we're looking at is a little bit weaker than, a lot weaker than anticipated. And it's the first month in the last 15 that's come in below the economists' expectations.
All the way back to the March report of last year, which we got in April of last year. Amazing.
Yeah. Do the markets, John. I think it's important here.
Let's push it through this market. Equities recover a little bit. They pop. They turn positive on the session. We're up by, let's call it 0.1% on the S&P. We were slightly negative going into the print. Off the back of this downside surprise on the headline number, payrolls at 209K. Bid at the front end. You might expect that yield to lower by 5 basis points. We break back down through 5% on a 2-year. Let's call it 492. Off the back of that, you'd expect some dollar weakness. You've got that. The euro against the dollar back through 109.13. We're positive by 0.2% on that currency pair. But I'd say a couple of things about this, Tom. Downside surprise on payrolls, but look elsewhere. Unemployment's lower. Average hourly earnings, better than expected, higher than expected.
No question.
Average weekly hours worked, just a little bit longer as well. So some important developments on that front. More mixed than maybe meets the eye. And Mike McKee's going to have something to say on that, I'm sure.
Round of applause. Ellen Zentner, Morgan Stanley, with us moments ago. She absolutely nailed the impossible with the revision. You have a 99,000 statistic that is sub 100,000. This is the slowdown she was talking about, which was an outlier 20 minutes ago. But with 110,000 revision, the math is 209. Take away 110, and you get under 100,000.
The April numbers were revised down from 294,000 to 217,000, down 77,000, and then May down 33,000. We mentioned that. So you see from April, May, and June, a weaker labor market than people thought. So this is probably going to have an effect on the Fed, even if the average hourly earnings are not specifically changed. Not much change in terms of the unemployment rate. While it did go down, we saw 273,000 new jobs in the household survey, and unemployment fell by 140,000. So we've sort of reversed what happened last month when we went up to 3.7. So this is all going to raise the questions of soft landings and things like that if we continue in this area. I might mention that construction hiring up 23,000. So the home builders are really keeping the economy going here. The other big employer was government. Government was up 60,000 on the month, and little change, a gain of 21,000 for leisure and hospitality. The BLS puts it as little changed, but that compares with 232,000 in that ADP report. So ADP way off this month, and I don't think anybody's surprised to hear that, but the labor market has clearly slowed.
Mike, thank you. You're going to spend a little bit more time on that. Stocks positive, turning positive off the back of this data. Coming up in the next hour, we'll catch up with Mohammed El-Arian, Rick Reeder, Victoria Fernandez, Michael Collins, all on this market, this economy, this payrolls report. Then a little bit later that hour, we'll catch up with Julie Su, the acting Secretary of Labour as well. Tom, just to get the view from the White House a little bit later this morning.
Yeah, they're going to look at it and they're going to see some softness here with the revisions as well, but they've got to go to some form of wage lift. What we're going to do here, folks, to inform you is Lindsay Pieggs is going to join us here in a moment, but first we have Randall Krosner with us. He's a former governor of the Federal Reserve System, truly one of our nation's experts on our financial economics. Dr. Krosner, I look at this report and clearly we're finally seeing some wage lessening. Some unemployment, non-farm payrolls lessening as well. That buttresses against rising wages. How are those two balanced at that long table at the Eccles building?
I think as Mike was describing, the wage growth is still stronger than the Fed would feel comfortable with. They want to bring inflation down to 2%, and if wage growth was revised up last month, it's still strong and around 4.4%. That's going to give a lot of people some concern, and so I think they're going to say we need to move forward, even if we're starting to see a slight softening of the labor market. I mean, maybe this will be the turning point, and maybe we'll remember this as that was the last time we had a strong report. That was the last time that we had an overshoot, and that the market is going to and the labor market will weaken. but they really will want to see some evidence that the wage rates are going down.
You know, I look at Chicago and Booth School, and of course there was a professor there that his course, Turning Points and Humility. Austin Goolsbee, Professor Goolsbee was brilliant in that course, Turning Points in Humility 302. What's the level of humility this Fed has to have? Can they take what we're seeing right now, a non-farm payroll slowdown, and use it as 1 point, or do they have to see some form of moving average?
They don't overreact to any one number, or even any one revision. So they're going to want to see something that is a sort of a sustainable trend downward in wage pressure. So if they see that the labor market is starting to weaken, and that the unemployment rate starts to move up, job growth starts to slow down, they'll start to feel comfortable that wages will move down. But they're going to wait, I think, to see wage movement start to move down before they say, "Oh, all clear, we can just stop." Now, remember, they're just going to stop. They're not going to start cutting. They keep emphasizing that. The markets don't seem to believe it, but I believe them that they're going to hold it. Unless there's some sort of cataclysm, they're going to hold rates wherever they end up finishing in the mid-fives, and they're going to hold it there for a while.
Professor Krasner, thank you so much. With the Booth School of Chicago, Randy Krasner, so helpful to us on Jobs Day and often when the Federal Reserve meets. Got a green on the screen, a little lift of the market off the carnage yesterday. I'd point out a lot of movement in yields. A 2-year yield comes in with a nice vengeance from a 5 level and now 5 basis points, 4.95%. 2 stents disinverts out to 93 basis points, less of an inversion. And even the real yield pulls back the 10-year from 1.80 to 1.76. The jobs report is 47 pages. McKee's on page 14. What do you see?
Well, a couple of things that are worth noting here. The average weekly hours rose 34.4 from 34.3. And there had been a storyline that employers were hoarding labor, did not want to let people go, but were cutting back on their hours to save money. And it does seem that they were busy enough to get them back to work. The interesting thing about unemployment rates that comes through is that it is the lower socioeconomic groups that are losing ground. We saw for the race groups, Black or African American goes up from 5.6 to 6.0. Asian goes up to 3.2% from 2.9%. Wow. Whereas white unemployment is lower at 3.1 from 3.3. And you look at the people with a bachelor's degree or some college, unemployment went down for them, but those with less than a high school diploma or high schools, no college, it was unchanged or went up. So this does have some of the starting characteristics of maybe a labor turnaround, because you're letting the last hired to be the first fired.
We're beginning to see some bond market movement here as we digest this data. Joining us now, Lindsay Pieggs, the chief economist at Stifel as well. And to me, it's a hallmark announcement, Lindsay, with the revisions. Let me go through the math again. It's simple. It's algebra. I can handle this, Lindsay. I can't do the differential equations like you. And that is 209,000, take away 110,000. Can you frame this out with the revisions as a sub 100,000 report?
Well, I do think it fell well short of expectations. But that being said, it's still a solid headline number. And for the Fed, the focus is not that top line non-farm payroll report. They're looking at the details. They're looking at the inflationary components. And with the unemployment rate declining, wage growth gaining momentum, this is the exact opposite of what the Fed wanted to see. This keeps the Fed on the path for an additional rate increase later this month. And depending on what we see from the inflation data next week, we could see another rate increase shortly thereafter.
Our audiences on radio and television are saying, wait, wage growth, 4.4%, take away 5 or 6% inflation, depending on whether I'm buying steak this weekend. And the answer is they're not getting ahead. Which nominal wage growth does the Fed need to see? 3.5%, dare I say 2.9%. How low do we have to bring down wage growth?
I think I think if we saw a two-handle, the Fed would be very comfortable with that. I think that would give the Fed confidence that we're on a sustainable downward trajectory. Right. That's what the Fed wants to see. It's not about getting inflation under control from 8 down to 6. It's continuing that trajectory back to that 2% target.
Give me the x-axis then on a 2.9% nominal wage growth. We're distant from that, aren't we?
Absolutely. Absolutely. And one of the biggest fears for the Fed is that wages are continuing to rise. Growth is continuing to accelerate without any improvements in productivity. And so there we start to see this wage price spiral leaving the economy behind. Growth is slowing. We know that. But if underlying wage components continue to increase, what is the economy gaining from that? It goes back to the old adage of we could hire 1 million workers to make windows, 1 million workers to break windows. If the supply of labor falls short of that, wages go up, but we're not adding anything to the economy.
I want to make clear, we've really got some flightiness on the data screen as well. Right now, red and green in the screen, futures at -8, NASDAQ barely to the green side as well. In the yield space, there is some movement, 4.96% on the 2-year, the 10-year yield, 4.04%. These are all new numbers for me. They're really a shock to see in this high, 4.01% as well. How many quarters of, as you say, 209 is still a substantial non-farm payrolls number. But if we developed a 3-month moving average of 190,000, my reading is that doesn't get it done for the Fed.
Well, it
You've
depends.
Still got to sustain.
Where are wages at that point? We
so
have
you
to
really
see.
hinge everything on wages.
Well, inflation. Wages, that's one component of inflation. But we need to get that under control. We need to see some of that tight labor market conditions ease so that the Fed feels more confident that wages will begin to ease. Now, that doesn't mean that they're going to tackle overall inflation then just by getting the labor market to become less tight. There's other components of inflation. But that's the component that the Fed can control. That will determine the terminal level. The other components of inflation will determine how long the Fed is forced to maintain that elevated level of rates.
Give us a Stiefel granularity of what Mr. McKee talked about, which is the racial makeup of jobs. We saw some higher unemployment, some jumps in unemployment among minorities, and also on the education basis as well. The stereotype within financial media is we have a lot of service sector bartenders and waitresses still being employed. Do you buy it, or is there a different story here?
Well, I think there's two different storylines. Certainly, when we look at where the most unemployment is gaining momentum, that's at the lower skills level. We're starting to see technology replace those lower skills. This was something that was happening before the pandemic, but this is a trend that has certainly been exacerbated more recently. But I also think that we haven't yet seen that cyclical component suggesting that weakness is lurking around the corner just yet. As we heard about, leisure and hospitality still posting a sizable increase this month. That would be assumed to be the one area where we would start to see that weakness gain credibility, gain evidence, but we haven't seen that quite yet.
Is this still a pandemic-tinged report?
I don't know if we can necessarily say that the pandemic is influencing this report, but I think the aftermath of the pandemic, the change in psychology, is impacting this report because we're still seeing millions of workers sitting on the sideline, not actively participating as we would expect in the traditional manner in the labor force. So we do need to still think about providing an incentive to pull some of those sideline workers in that may help to expand the labor supply and then organically reduce wages. But we're not going to see that downward pressure unless we see demand for labor precipitously decline or the supply of workers dramatically increase.
Lindsay, thank you so much. Lindsay Pieggs with us today from Stiefel. She's going to go right up a storm. We'll have that report for you later this afternoon across radio and television as well. McKee's now through page 14. He's good news. He's up through page 25 as well of 42 pages. There's got to be some other things in here. Fascinating report.
Well, there's a lot you can look at in here. We are looking at the unemployment rate. What happened there? Well, we did see the labor force rise by 100,000 333,000, but more people got jobs, 273,000. Remember, last month they lost in the household survey 310,000, and it was the reverse in unemployment. The level change goes down 140,000, and the prior month was up 440. There's always this tension between the household and the establishment survey, and given the arguments among economists at this point about what the Fed should do and whether the labor market is strong or not, what you probably want to do is pick a side. Are you a household person or are you an establishment person? Most people would be establishment people.
Michael McKee, thanks so much. Right now, we're going to give the focus here on the bond market. It has been front and center since the shock ADP report, a ginormous statistic. And if you're just joining us, we subside off of that to a lesser number. Just critically here on the actual statistic, the survey was 230,000 with a whisper number. Mike McKee said higher. We came in nicely off that. 209,000, but critically with a negative revision as well. It has moved the bond market, which means it's a good time to speak to Ira Jersey of Bloomberg Intelligence. Ira, is the two-year yield of value here to study at 5.05%, plunging now down to 4.97%? Does that give you an indication of the pulse that's out there?
Well, so the 2-year right now is really pricing for the Federal Reserve to hike 2 more times. So around 5.08 should be fair value if the Fed's going to hike to around 5.5%. And primarily because once the Fed hikes, the market is going to keep on pricing for interest rate cuts at some point in the future. We keep rolling forward when the interest rate cuts are going to be. It's always going to be, it seems like the market thinks 6 months after hikes end, but the problem is we keep pushing out when hikes are going to end. So I think right now, assuming that the Fed's going to hike 2 more times, 2s are not particularly rich or cheap. If they only hike once, then obviously 2s look a little bit cheaper.
Help us here then with what we see farther out. I mean, the last time you and I talked about a 4% 30-year bond, I think we were younger, Ira, to say that's back when the Tottenham was winning. And the answer here, Ira, is I got a higher yield regime. Does that have a stickiness to you?
Yeah, so I think the long end for the rest of this year is unlikely to basically move, much out of the ranges that we've established for this cycle. And in fact, we are coming to a pretty important technical level for 10-year yields at 4.09%. Now 4.09%, that means if we break that, we probably go to about 4.25. But these again are ranges that we've established over the course of this cycle where we're looking at 3.5% to 4.25%, where we could probably stay there. It's really this, the front end of the curve right now is really what's driving the yield curve inversion. It's the fact that 2-year yields are so high and the long end is just kind of hovering, 4% plus or minus 25 to 50 basis points.
You said it better than me. Ira, are we breaking out of the range we've been in on these various yield metrics? Are we breaking through to a newer, higher regime?
Well, yes, temporarily. I think until the Federal Reserve stops hiking interest rates, it's going to be hard to go back and retest that 3.5% 10-year yield. Given that we're saying now, hey, the Fed's terminal rate's going to be a little bit higher, then the entire yield curve has to shift up a little bit, and that's exactly what you're seeing. And obviously, the front end, as you noted before, Tom, the front end is where all the action is, right? Going from, we've gone up about 80 basis points in yield just in the last couple of months in 2-year yields, whereas 10-year yields have gone up, maybe 40 basis points.
Okay, but I understand the United States has a certain lift to the 2-year yield. I would suggest it's radically different than, say, what we see in the United Kingdom and the 2-year gilt. With that said, does the 2-year yield lead the discussion going out, the belly of the curve, the 5-year, out to the 7-year, out to the benchmark 10-year, dare I say, out to a 20-year muni or a 30-year full faith and credit? Does it lead?
So the answer is no. Actually, it's that belly that leads. So you mentioned the 3 and 5 year. That tends to lead because you have more of the future expectations built into those yields rather than the 2 year, which is going to be much more highly influenced by the policy rate and what's going on today with the Fed. So you look at something like the 5 year. We were rallying when we were thinking, hey, the Fed's almost done. The Fed's going to be cutting interest rates in 2024, and then more aggressively in 2025. So that 5 year rallied a lot. Now you're seeing the belly of the curve actually underperform, and in part because now everyone's saying, oh, we might have this higher rate regime where not only is the Fed's terminal rate going to be higher, but maybe they're going to keep the terminal rate there a little bit longer than we expected. The market was not believing the Fed basically until the last couple of months, and now it seems like everyone's saying, the market is saying, hey, we now believe the Fed. We're going to trust the Fed and what they're going to be. What they're saying is what they're going to be doing.
If we believe the Fed now, are we believing that yields move up, dare I say, and migrate to a new somewhere near 6% level?
Well, very few people even at the Fed think that they're going to hike to 6%. The yield curve is going to remain inverted in my view, at least until the Federal Reserve cuts interest rates a number of times. And one of the reasons for that is, that the market is of the belief that the Fed's going to basically be successful at some level, going to see lower inflation, going to see lower growth, and at some point they're going to stop hiking in the next 25 or 50 basis points. Once they do, the next move is going to be a cut, and the market's going to perpetually price for that. And because of that, you'll continue to see maybe a higher rate regime. Like, we're not going back to 1% 10-year yields, I don't think, but we could certainly see. We're probably not going to see a 5% or a 6% 10-year.
You're warned, Ira Jersey. A question from Michael McKee as he looks at the data. Ira Jersey does yield. He's in the real world, unlike you.
He does the real world. How much are expectations for the Fed actually pushing around the curve on the short end? Are we seeing people react to the jobs report, or are they reacting to the idea of what the Fed may do with it?
Well, they're reacting to So whenever we get these data releases, so it's obviously the payrolls report is the granddaddy of them, and in fact, it actually the market reaction tends to be twice as large to any miss or beat than the next most important data release. Obviously, CPI next week will be an important factor as well. So it's basically the instantaneous adjustment of the market's expectations for what the data is going to do, where the economy is going to be, that ends up creating these knee-jerk reactions.
Yeah.
Initially we saw that massive rally in the front end in the 2-year yield, rallying 6-7 basis points. We then came off that after everyone, looked beyond the headline red headline number and listened to Mike McKee and saying, well, it's actually much more of a mixed report. It's not just a weak jobs report when you look at things like the wage data and some of the hours work data, as Mike noted earlier in the show.
Lindsay Piegza really emphasizing the wage data with the inflationary push there as well. Ira Jersey, thank you for the brief with Bloomberg Intelligence. For those of you with a terminal, he and his team, I'm sure, will be publishing into the afternoon on a new bond regime. Let me tell you about that right now, red and green on the screen. The VIX 15.33, the 2-year yield of 5.505. I'm going to go off where we were at peak. We're down 10 basis points off that, 4.95%. 10-year yield still above 4%. 30-year bond still above 4%. 2-10 spread, 92 basis points. We disinvert over the last 48 hours as well. And the tip was at 1.80 down to 1.75. Now up to 1.78. I can't believe I'm doing all this micro adjustment on yield as well. Edward Harrison holds court for Bloomberg in Washington. He's with Bloomberg Markets Live, and we're thrilled he could join us now because he had to survive the most intimidating undergraduate prospect I know, which is Douglas Irwin on foreign trade and all American trade and our trade wars and trade economics, and ungodly had to sit through Blanchflower 101 up at Dartmouth. Ed Harrison joins us this morning from Bloomberg Markets. Ed, I look at the report, and I look at how you apply it into the real world of what to do at Bloomberg Markets. And I love your phrase, duration seekers. In your recent report on duration seekers, what are the yield hogs doing that desperately want to go out 42 years?
Yes, Tom, I think that the yield hogs are looking to pile into the longer end of the curve, thinking that now is as good a time as any to do that. And actually, up until this report, I would have said that was probably a little bit premature. But interestingly, this report confirmed some of the weakness that I had been seeing in the data. If you look at the rolling 12 and 6-month number of unemployed in the United States, through the data back to 1948, what you see is that number actually declines to a low right before a recession, sometimes right at the beginning of a recession, but usually right before a recession. And what we've seen is that in April, we hit that number, that low. And the data that came out today confirmed that both May and June were higher on that rolling basis. And so what that says is that maybe those yield hogs are correct, that now is the time to get into the long end of the curve.
I mean, Ed Harrison, what's so important to me here, and of course this is the heritage of our Washington News Bureau folks, Craig Torres, Rich Miller, and the rest of the thieves down there. And, you know, Ed, I look at what you guys do, and it's always history-based. What is your study of the if and when of how we disinvert? We have massive curve inversion, and I guess at some point that's going to go away. When we disinvert here from 105 beeps to 91 beeps right now, how does that happen?
Yeah, you know, that is a very good question because we've had some bear steepening, and that's caused, say, for instance, a 3-month 10-year to disinvert 60 basis points. But I think Ira was right on the money when he talked about it's the cuts that are the real disinversion that we're considering. And the real question is whether that disinversion happens before or after the recession. You know, in the post-Greenspan era, the post-Volcker era, it's always happened before the recession. That is that we see a disinversion be up beyond zero, so that we have an upward sloping yield curve before the recession. But this could actually be a recession that's more akin to what we saw in 1980, where the Fed keeps it tight right up until the recession and even after the recession.
What are you going to write about today and into the weekend? I mean, you write such a curious piece for Markets Live. You never know what you're going to get from Harrison. What are you thinking about writing about 2-3 days forward?
I'm thinking about this as a confirmation that we actually have more weakness than we had thought. I mean, there's a lot of angst about is this cycle going to continue on? How much longer is it going to continue? Because everyone's been wrong about where the cycle has ended. But when I look at the data that came out today, it's more confirmation of the fact that this cycle is very late.
Ed Harrison, thank you so much for the brief. Really love it. You can see Ed Harrison, M Live, Market Live, and of course his work out on the terminal. So it's really eclectic stuff about how Ed Harrison out of Dartmouth and Columbia, how he applies all this econobabble over to, okay, what are we going to do about it? Which is a little bit of applied economics and implied investment that has a value. I'm going to review this right now. Tell me here how I'm doing on time, guys, because I'm going to review this, and I want to be sure we try to get the whole story in. Futures tepidly weaker. S&P futures at -6, a VIX 15.46. In the yield space, it's just a jumble. I have a higher yield in the 10-year, 4.06%. 2-year comes back under 5 with some significant disinversion. The real yield back to 1.80%. What do you need to do? The acting U.S. Labor Secretary with Jonathan Ferro, Julie Su in the next hour. Good morning. This is Bloomberg.